Morning, everyone. Just a very good morning. Hope like you have a very fruitful day yesterday. And we will just need a couple of minutes to sort out some of the logistic issues, and then we will start the session. Very good morning, everyone. Thank you for being here, even though it's the second day after a very long day on day one. So really appreciate everyone being here, and also apologize because I know many of you actually already been here punctually at 9 o'clock, but because of some logistic issues, we sorted that out. Now everything is under control, and then we can definitely start day two. Most of you already know who I am, so I just skip the part. Now we are going to the first panel discussion. And before we start the panel discussion, let me introduce one of the speakers who will be delivering the presentation first. Let me introduce, that is Ms. Ashima Tayagi, Economics Associate Director, Pricing and Purchasing, S&P Global Market Intelligence from Singapore. With more than 14 years of all-around experience in leadership roles within the commodities space, Ms. Ashima's expertise lies in the metals and the mining domain, encompassing macroeconomic research, pricing, procurement strategies, and data analytics. She has several white papers, podcasts, and conference presentations to her credit. In her previous role, she served as Assistant Director at the Indian Steel Association, New Delhi, representing at the highest levels in the government of Indian offices as well as international bodies like World Steel. She has a master's in business administration from MIT Business School and a bachelor's degree in economics from Shriram College of Commerce, University of Delhi. Now let's Ms. Ashima to come onto the stage to deliver her presentation. The presentation topic is Flux in Coal and Steel Markets 2023.
A very warm good morning to all of you. It's a pleasure to be speaking at Steelman's Coal Conference, and I'm really thankful for the opportunity. I'm Ashima Tyagi, Economics Associate Director with S&P Global Market Intelligence, and I'll be talking about flux in coal and steel markets, because as we know, last couple of years, um, commodity price volatility and uh, flux in the whole system has been the mainstay. Um, yeah, so really happy to be interacting with you, and this is how I've structured my presentation. I'll be first giving a more macroeconomic view, kind of piecing together everything that we heard yesterday and trying to put the whole picture into focus for all of you. We'd also talk a little bit on labor environment, which is, I think, a very important matter for consideration. Then, of course, we'll look at the coal pricing outlook that we have and the steel pricing outlook. Steel is where my specialty is, and this presentation as a whole is efforts of a lot of my colleagues across different parts of the globe who have specific expertise and understanding, which is why I've been able to put this together. So thanks to all of them, even though they're not in the room. But yes, this is actually a compendium of information that is spread across different domains within our company. And then I'll end with a little bit information of how we do pricing and purchasing service at S&P Global. So yeah, first, the good news. Supply delivery times are at their best now since July 2019. That is pre-pandemic, as per S&P Global Market Intelligence's Purchasing Managers Index. So this February actually marked the 10th straight improvement from the lows of April 2022 and the all-time low, that is the slowest deliveries on record in October 2021. So this is great news. The supply chain disruptions that have been ongoing, they are in the best place right now. In fact, evidence from Q1 also suggests a normalization in logistics networks. Simply put, container shipping rates based on Shanghai Shipping Exchange data, they have declined to September 2020 levels. So a combination of improved shipping rates, shipping times, And increased quantities of purchases has meant that stocks of purchased goods has started to increase after the downturn that we saw in 2022. And of course, looking forward to 2023, supply chains should continue easing, especially when there is an anticipation that global trade activity is expected to slow. Coming to another good news that's there, the global economy is performing better than anticipated when 2023 began. You remember, end of last year, there was this great certainty that recession is on the cards, but you would have read the news today and a lot of flash PMI that came in yesterday. Even April is doing very well. So global real GDP growth, it actually picked up from 1.5% quarter over quarter end of 2022 to an estimated 2.5% in Q1. Now again, you would ask, where is this growth coming from? Because it's been all gloom and doom that we've been talking about. Our PMI surveys through March signal strong post-pandemic resilience in service sectors alongside a very subdued growth in manufacturing. And this dichotomy is apparent across different regions. So, this is the key point to note. GDP is doing well, countries are doing well, but that's primarily because of service industry and not manufacturing. And manufacturing is what I think all of us in the room are looking towards when it comes to commodity markets. In fact, detailed sector PMI also revealed that economic growth in March was actually because of resurgent spending by consumers on services such as travel and tourism. On China, of course, which will be the focus throughout this presentation, we see, of course, a robust post pandemic recovery, low base effects. It will continue to support growth. However, here comes the caveat, the month over month moderation in momentum across industrial production, fixed asset investment, and retail sales indicates that the reopening driven rebound might actually be over. Because you know, COVID cases in China actually peaked somewhere in December, and perhaps there would be moderation going forward. Now, here is an area where we need to be a little bit concerned about. So, a banking crisis has been averted, but we need to watch out for financial stresses. So, we've all read papers about the mid March collapse of Credit Suisse and Silicon Valley Bank. Rapid regulatory intervention has prevented wider financial instability and calmed the markets. However, this episode has exposed some structural problems in banking that will not be quickly resolved. And you would ask, what are the repercussions of these developments on Asia? How will global growth be suffering? Of course, I think there's going to be ramification if in US the financial markets are not stable. So, of course, commercial real estate loans are subject to rising default risk in a market of increasing interest rates. Bank deposits, meanwhile, are become increasingly mobile as customers are seeking higher yields or increased insurance coverage. So what will happen is that banks will hold more liquid assets, they will reduce lending, and of course tighten, the credit standards that they have. Of course, Europe and North America will experience subpar growth, but this will have ripple effects on Asia as well. In markets, in times of high inflation, this is bound to have an influence on Asia as well. Then again, another important factor to look at is, um, how weak demand is, kind of driving some sort of deflation in. Yeah, one second. I think there's a little bit mix up of my slides here, but let me go for it. So basically, we have a material price index, or maybe let me go to the next slide first and come back to it later. Yeah, so I think labor market is something that is not often discussed as much, but we know the labor market has been tight recently. And this again is something that we in the pricing and purchasing team really look at, the cost of labor and the relevance of labor market in today's inflation fueled economies. So what we are seeing is there's a very mixed outlook for wage growth gains in Asia. We are, of course, seeing stronger economic growth and labor shortages in Australia and China, which will lead to strong wage gains, while there's a softening demand and there's easing inflationary pressures in Japan and India. So the wage growth there would be much more smaller. In China, of course, there is a huge demand for labor in response to the economic reopening. But there are there's several factors that are clouding, how this market is going to behave and how the rebound in wages is going to be. So, of course, if there are stimulus measures, if there's a lot more pent up demand coming in, and of course, a shrinking working age population in China, it will definitely support more wage growth gains. However, there is also this sense that there is a less willingness in the Chinese markets to consume because household confidence is still not completely back as yet. There's of course property market weakness, which is also holding back construction investment, and the economic policy is also not super aggressive as you might have seen, and it's simply just supporting the markets a little bit. And there's of course weakness in external demand emanating from manufacturing, etc. So I think this aspect of the business, which adds to the cost, is again a very important factor that we should look at. Again, here comes what we call the MPI at S&P Global Market Intelligence. It's basically materials price index, which is a weighted average of weekly spot prices for key collection of globally traded manufacturing inputs. So it will not just have the energy basket like coal and oil. It would also have steel. It will have pulp, paper, lot of globally traded manufacturing inputs, which give an idea of, just stepping outside of our coal discussion today and just looking at overall commodity space. So the story of 2023 so far has been of falling commodity prices. Our MPI was decreasing in 10 out of the 14 weeks, and the index is also 30% lower than its year ago level, which was obviously the all time peak, after Russia's invasion of Ukraine. And of course, declining energy prices is contributing the most to this drop that we are seeing. Even last week, I was noting that LNG prices in Europe are actually around $12 per MMBTU, uh, in contrast to $70 that was the LNG price in August 2022. So, of course, I mean, overall, we don't see a lot of positive sentiment to boost commodity prices. And this is, I'm talking overall commodities that we track. What we see is that markets are continuing to grapple on, global economic growth. They're getting a lot of mixed signals, as you can see. US core inflation is still stubbornly high. It's at 5.6% in March. And however, at the same time, there's strength in employment, there is, there's income, there's consumer sentiment, that, there is a sense that Fed is going to increase the federal funds rate one last time in May by 25 basis point. So this, high interest cost combined with falling natural gas prices for producers will ultimately, I think, contribute to, much lower commodity prices in general. Let me go back to the slide that I missed here. Yeah. So this is where we look at our IHS market, now S&P Global Materials Price Index, which is on the left side, and of course all the PPIs that are being mapped here. Now PPI is important because it looks at the producer price index, and as you can see, it measures the cost of goods at the factory gate. And for China, this has been on a downsliding trend. It went down 2.5% in March. Uh, Definitely, the consumer price index also remained in deflationary territory, thanks to services price improvement. So obviously, I think this shows that there is scope for the manufacturers to really, not really push prices beyond a certain point. Um, I think most of the consumer price disinflation that we are seeing in March came from falling energy prices. And of course, LNG and coal is a contributor to that. Um, uh, we've seen a little bit of shift there with oil kind of bouncing up a little bit, but natural gas prices really toning it down. And of course, the natural gas price will have its effect on coal price and electricity price. So then this is very interesting to see that while we talk about CPI much more, which is what ultimately the consumer pays, the PPI actually in China has been in deflationary territory. So coming to, I mean, the main focus of the presentation, I think today, what we in pricing and purchasing look at, we don't look at very regional specific thing. We look at more holistically. We have our colleagues in US, London, and we all work together to see the overall dynamics and not look at maybe the Asian markets in isolation, because we all know that they're all super linked. So according to us, and this is our forecast of February, we do most of our forecasts on a quarterly basis. So this is what we forecasted in February. Our next forecast will be in May. So according to our February forecast, and we are mostly right, thermal coal prices, according to us, could see further price correction in 2023 because of falling natural gas prices. So what we're seeing is supply conditions are very stable. Europe is very well stocked, and it's almost turning cargoes towards India. Of course, China and India will see a lot of demand this year, but coal in general is in far less global demand as the energy crisis has calmed. So last year it was very volatile, but I think this year it's much more calmer, it's much more stabilized, kind of trending downwards. So according to us, I think prices will fall in the second quarter. April is already underway, and we are seeing that US coal is likely to be sort of 10% cheaper, and coal prices will actually see some support ahead of the winter months, where the stocking activity comes into play and where storage is secured. So I think in that time we could see some pickup for Q2, Q3. We don't see too much of uptick. I think Europe is very well supplied because of the warm winter that it saw, and US also finds itself in a comfortable position. Mainland China is also turning to imports to supplement its domestic production. India, again, plans to be a net exporter in the next few years, but for now, I think with the heat wave and the news around it, will continue to be reliant on imports. So what we're seeing is that demand would generally be weak in 2023 compared to the highs of 2022 that we saw. And of course, natural gas and other alternatives are, much preferred substitutes, is what we see. And in Asia, of course, China would require more coal, and so would India. But we don't see that there's going to be some major supply shortfall that's going to come in. And with demand being steady, I think what our indication is that prices should, you know, uh, be on the downside. Coming to met coal, again, we've seen that Chinese steel production in Q1 was very, very strong. However, now you would have read news that a lot of steel mills are undergoing maintenances, which is another word for, basically cutting production on their own accord because of the slow demand. And some expect more is to be followed in May. I think HRC prices in Shanghai, it actually fell around yuan 4,180 last week, and drop below 4,000, which is a psychological mark, doesn't bode very well. And I think everybody anticipated a huge upsurge in demand because of China reopening in Q1. However, that didn't pan out. So now we'll be seeing some amount of cut. But again, even that cut will not lead to any sort of supply shortfall in some sense, or huge uptick in demand. So even for met coal, our indication is that prices are going to fall. Of course, we see that this market has become very news driven. One particular news could increase the price one day and drop it the next, but it's actually always in the similar band. And for us, we look at the whole picture, and I think what we're seeing is that there's a lot of slow demand recovery, and this higher production in Q1 has actually squeezed a lot of profit margins for companies. Again, because the property sector, which is the mainstay for steel consumption, is not still picked up. I think it hasn't picked up for many, many quarters. I think we are seeing slow recovery, and I think the home sales in March in China were also low. So I think all of these factors are contributing to not a great outlook. And I think we heard yesterday that even World Steel predicts that China's steel demand will only grow 2% this year. So yes, I mean there doesn't seem to be much happening with we putting the macroeconomic and the sector dynamics together. As you can see, I think GDP is improving, as I mentioned, but because of services and not manufacturing. So things like that are really adding to a demand slowdown. With such high interest rate, there is going to be a lagged effect on how the markets are going to perform. So I think we are yet to see the impact of these high interest rate. We're going to see it this year, though I think inflation peaked last year, is what we see. Not sure how many of you would be interested in steel per se, but I think it was important to highlight that I think steel prices in India, sorry, steel prices in Asia are also likely to retreat. I think mills have tried to really prop up prices due to various reasons, but essentially demand is missing. I think automotive sector is recovering, but very, very slowly. Consumption in China is not booming, as I mentioned earlier on COVID-19. Some people do think that, the China reopening game is, yet to play out, maybe in the second half of the year. But so far, we haven't seen, that amount of rebound, or whatever it was, it's already been taken care of. In terms of auto, as I was mentioning, I think the chip issue is kind of resolved, but again, there is some patchy shortages for specific chips that is still there. And we need to see that whether customers also are wanting to buy autos in this high interest rate environment. So I think naturally Asian coil prices wouldn't pick up if auto sector is not really booming in a big way, and there is no solid growth that we see. So again, for us, we see that i- coil prices, in America, definitely they continue to rise, but Asia is fairly priced. Europe is slightly above equilibrium. U.S. market, as we all know, works in a very different way. But in Asia, I think prices had begun to pick up. I think end of last year, and now they're kind of stabilizing at that level. And now with the production cuts coming in, there would be maybe a slight increase, but not much, because I think demand is still very, very humdrum. We also look at specifics, steel grades, and not just, HRC. We look at plate, rebar, wire rods. So I just wanted to give a flavor of, what's happening in the plate side as well. I think um, demand again is not very strong. These are sometimes plates used in construction, plates used in shipbuilding, and most of the end markets are growing very slowly, as I mentioned. So yeah, I mean, this may not be of a lot of interest to this audience, but I think it was important to highlight how different commodity within the larger group are behaving. And we look at each of them for their own, idiosyncratic marketing, idiosyncratic behavior. So I'll just like to, yeah, quickly end, the presentation talking slightly about what we do at Pricing and Purchasing Service. So we, of course, have hundreds of thousands of historical data prices, and this is not just in steel. We do it across different industries. We have a lot of reports where we give the forecast, and we actually give a particular buying strategy for every commodity that we forecast. So we wouldn't just give a number, we would actually show you whether you should buy now, which means prices are going to increase, or whether you just lock in prices. So, buy as needed, or you wait, because we definitely think prices are going to fall. So for coal, as I mentioned, our strategy is wait. I mean, prices are going to fall, definitely. And of course, we work with procurement managers to really allow them to lock in their price, because I think uh, continuing operations, they need the material on a continuous basis. And, you wouldn't take a call basis one news today or one price movement. You need to know the overall framework. So yes, we give a buying strategy that is very important, and we help companies save millions of dollars, is how we like to put it. Sorry. So yeah, I mean, as I was mentioning, for us, the focus is not just on upstream commodities or energy prices. We work a lot of downstream segments also. So as you can see, we have a great coverage across different domains. Labor is something that is our specialty, and which is something that I talked about earlier. Energy, of course, metals, chemicals, building materials, which would be cement or glass, and you name it, and it's there. A lot of downstream material like capital equipment, paper and packaging, logistics. So we have a broad coverage with a lot of information. And the best part about the forecasting methodology is that it's very integrated to what our team in the macroeconomics are projecting. That kind of trickles down to us, and then we also have a very input cost breakdown. Our basic fundamental ideology is that over a period of time, costs tend to exert the dominant influence on prices and not just the market and market activity. So at pricing and purchasing, we look at the input cost breakdown. So for instance, our team in the labor will forecast the labor price, and that will then feed into, for instance, a mining cost for a miner, and also adding capital equipment, also adding electricity, all of that price, and then we would go downstream like that. So it's a very iterative model. We have uh, it's a 50-year-old methodology, I'm told, and we have some 7,000 equations running behind that. And of course, the expertise of the forecasting analyst who understand the market inside out. And as I mentioned, this presentation is also the effort of all of them working individually and trying to put this together. So yes, with that, I'd like to end the presentation. Looking forward to the panel discussion later. And thank you so much for listening in. You've been a great audience. Thank you.
Thank you very much, Ashima. Actually, the company logo bring back a lot of memory. Well, they moved the chair. Let me introduce my panelists. So we'll be having four, including me, sitting over there doing the discussion, the panel discussion regarding quite a bit of commodities as well as, in particular, coal market. So with me, we'll be having Mr. Sabya Mishra. He's an engineering graduate from the Indian Institute of Technology and MBA International Business from Indian Institute of Foreign Trade in New Delhi. And he's serving business head at JSW International Trade Corporation in Singapore. With 28 years of international business experience, Mr. Mishra has worked in various industries and lived in various countries in Asia. And based in Singapore for the past 20 years, he has led the trading desks, minerals and metal sectors. He is currently business head of the JSW International Trade Corp, the flagship trading arm of JSW Group. And with a large presence in the steel, energy, and the cement sectors for the group company. And the trading company mainly trade in dry bulk commodities, including coal and iron ore. Now, let me introduce Mr. Jiyuan Wang. Mr. Wang is the marketing manager of Shanggu Group China. Mr. Wang has more than 12 years of experience in China's ferrous industry. He has been associated with renowned consulting companies in commodities, CRU, as well as Wood Mackenzie. In 2019, Mr. Wang joined the commodity trading subsidiary of Shanggu Group, China's largest state-owned metallurgical equipment producer. The trading arm deals in steel, coking coal, and coke in northwest and central China. Mr. Wang's primary role is to analyze and forecast market fundamentals via monitoring a series of market indicator sentiments, related industry policies, as well as the prices of China's steel and steelmaking raw material. So you can see that we have very nice mix. We have of the speakers. We have thermal coal, we have non-coking coal, we have the macroeconomy, as well as a series of commodities. So without further ado, I will just join them. Let's do the panel discussion.
Good morning. I'm audible. Is it working? All right. Thank you.
Yeah. Good morning. I'm Ziyuan Wang. Nice to meet you.
I think is my mic working? Okay. I think before we go into the panel discussion, it would be great if Mr. Mishra, if you can just give us a few highlights of the market you are particularly interested in and then dealing on the daily basis.
Thank you. I think Ashima gave a good introduction to the macro background and how we have going through a turmoil or what she called a flux. As we sit here today, I think 12 months back, if we just rewind our memories, I think we are seeing the highest ever prices on coal at this point in time in April 2022. Record highs, which were never seen before. Unprecedented times. We are into the territory where nobody knew what's going to happen. From there, 12 months on, humans have a tendency to have a resilience, high amount of resilience, all of us have. And we have found ways, we have found methodologies to find the best sourcing options for our companies, our countries. And now I think we are into a phase which is relatively stable in terms of the flows. Uh, because of the geopolitics that happened last year, I think people moved coal from places they never thought they would move coal out of. People went to Tanzania, people went to Kazakhstan, and they all over the place, and they started looking for coal. I think that 12 months churn, I think, has given the industry a lot more insights as to the supply and demand where they stand. Like one of the participants yesterday mentioned about Russia. They also went through their churn of finding alternate markets, what could be their potential destinations, and they have probably added 3 times more destinations now than what they used to do before. And same has happened for the markets which are buying, right? So they looked at various other options. So as we have gone through, I think the last 12 months, and I feel that the markets are, as Ashima mentioned, looks relatively stable in terms of pricing, primarily because the demand sentiments, which was driven primarily more out of fear, fear that what's going to happen, am I going to get enough? So people are storing more than they need. Those things have gone. So people are just storing only enough as they require. So as you can see, the storage numbers across the countries, it has dropped dramatically from the levels of Q2 2022, where there was overstocking in fear of not having enough. So as we enter into a phase where we are back to pre-22, I think it will be purely supply-demand game going forward. We are into a territory where we feel that, oh, it's a sudden drop in price, but if we just juggle our memory, we're back to the normal pricing times. So my view is that as the stability has come in, the volatility is going to be more of a supply and demand play. So supply and demand play, I would like to touch upon the Q1 figures, which has mostly come in for most of the countries by now for this calendar year. And if you look at the numbers, they're not out of line. They're pretty much in line with what they did last year. China, everyone touched upon being a little bit on the slower side, but the numbers say otherwise, right? If you look at the China Q1, they imported 100 million tons in Q1 itself, which is like 1/3 of what they imported the last year. So it's already, the numbers are not showing that there is any slowdown. Yes, they have been price bound. They are not jumping at any price that's being thrown at them. They have enough domestic supplies. They always had enough domestic supplies. As we all know, China imports only 5% of their total demand. So 5% becomes 4%, the world starts feeling the heat. But for them, it's only 1% change. That's what we need to keep in mind. India remains a bright spot in terms of this global turmoil. As we know, people call it, it's probably India's decade, which is, they're benefiting very well from China plus policies, followed by most of the Western world. And a lot of investments, a lot of domestic demand, economic activities are very strong. I think probably it's talking about a growth rate of 7%, which is probably the strongest in Asia. So a lot of good things going for India. Um, like as we heard yesterday from our eminent panelist, a lot of ramping up of the domestic production also happening. We expect a lot of commercial mining to come into play in the next few years. But yes, the growth of 7%, which is also in power demand, also we are seeing a good uptick in the steel demand. So with that 7% growth, the rise in the domestic availability is not matching up. It's still 4 to 5%. So I think that 2% gap still remain until these commercial minings come into play. So I think the import will have its play, growing at least 2% per annum, with that gap to be filled up. Then you come to the ASEAN countries. I think Vietnam, as we know, did slow down in the last 2 years from its peak of 2020. 21 and 22 saw only 30 million tons each year. But I think this year would be a rebound for Vietnam, given that the prices are back to the normal state. It's a very price-sensitive market. I would expect Vietnam to improve on those numbers this year. There should be a demand uptick from there. Similarly, I think we are seeing a steady growth in demand in Korea, Japan. I think the numbers are still stacking up. There is no reason to feel that the gas is overtaking coal at this point in time in these markets. The Q1 numbers are in line with last year's imports. Now coming to the origination markets, right? So if you look at Indonesia, they had a bumper year last year, 460 million tons of exports. Fantastic year for them. I think this year probably Indonesia may struggle a little bit in matching those numbers, primarily because you have a good volume of Russian coal flowing into the traditional markets of Indonesia, which is Korea, is buying quite a bit of Russian. Taiwan is also into Russian. India is substantially into Russian. So a lot of these power generating companies, they find a lot of value in the high CV Russian low sulfur, low ash coals, very well suited for power generation. They never came to Asia before. So I think those coals are definitely, as long as they're pricing well, they would be a preferred coal to a high, low calorific value coals from Indonesia. So to that extent, I think there'll be some demand erosion for high CV Indonesian coal in that sense. But I think Indonesia probably would have some supply challenges as well this year. So the figure may not really hurt the miners. Then coming to South Africa. South Africa has a very peculiar challenge. So its traditional markets are currently not there. So it's Europe is pretty much slow for this first part of the year. But Pakistan, which used to be a good market for South African coal, is struggling with its forex challenges currently, the economic challenges that it is going through. So with Europe and Pakistan not being there for South Africa, they are struggling to find some new markets. They have done well to get into Japan and Korea. The flows have started to be there, but they have to be competitive against the Russian flows into Korea particularly. To remain competitive in that market. Then coming to Australia, I think Australia did some beautiful flows into Europe last year in the challenge of the macro economy. I think they had opportunities. They moved well. As somebody was mentioning yesterday, their dependence on China did reduce by they being creative about creating new markets. I think that's going to put them in good state this year with a very diversified market that they have now. So I think there I don't expect much change on Australian flows. The whole part of this year it will be pretty much the same, around 300 million tons between thermal and coking coal flows. I, then that brings to probably the other origin, which is Russian. Russian, I think, uh, as I was mentioning earlier, they have found quite a few diversified markets. And I think we tend to think that it's only China, India, Turkey, but it's not correct. So there's quite a bit of flows into other markets as well, as I mentioned earlier. Uh, Interesting to see that whether they can hold the numbers of last year, because first 6 months of last year still had Europe in it. So this year it's not going to be there. So not very sure the numbers would stack up, but they have definitely done well to create diverse markets. Uh, Now coming to US, I think US flows, again, US have a very good domestic demand. Let's not forget that. So their exports is not that big. But even their traditional market of Europe is been absent, at least in the beginning of this year. So I think they are trying to find flows into India, flying flows into Turkey, into Asia. So I think those markets, they would definitely try to be strong for the rest of the year. Uh, so I think their overall exports would still remain the same. Maybe second half of the year with Europe coming back for winter probably would also help them back again. So overall speaking, my view is the world supply and demand, there's no major disruptions expected. People have balanced out with the optimum logistical costs, which was a nightmare last year, where people are paying almost $90, $100 freights to move coal from one place to another. So I think we are back to the normal logistical costs, and that should help the end users quite a bit, that they're not paying exorbitant prices for their intakes. That's my starting thing. Sorry, it was a little too long. So,
No. It's very comprehensive, covering all the major global markets. And so now, before we, kick into the question part, Mr. Wang, you want to give an overview, especially about the China?
Yeah, sure. Thank you. Firstly, it's my honor to be invited into this conference and share my views. More importantly, I could learn from you, from other people, to get their views. Today, I want to especially show some views about the China's coal market. In my opinion, I think China's coal market in 2000, there is a very important issue to define the China's coal market behavior in this year, which is the willingness of the inventory replenishment from the end users of non-electricity sector. Sorry, the sentence is too long. I will repeat that to make it clear that in 2012, in this year, I think one thing is very important for the Chinese coal market, which is the willingness of the inventory replenishment from the end users. And this end user are especially focusing on the non-electricity sector. And I will show you how this result comes. Please allow me to get some figures, because there are a lot of figures. I couldn't put all of them into my mind. And after we look into the supply, demand, inventory, and we will get and you will know why the results comes. Firstly, let's look into the non-coking coal market. We looking through the market from the supply part. You know that the coal production in China is huge. It's more than 4 billion tons per year. We estimate that the total coal production this year, in 2023, is around 4.3 billion tons. And within this amount of volume, the total non-coking coal production is something around 3.8 billion tons. Besides that, the total non-coking coal imports is around, we estimate around 260 million tons this year. So we can figure out that the total non-coking coal supply in China this year is something around 3.98 billion ton this year. This is the supply part. And from the demand part, we could separate end users into two sectors. One is the electricity sector, another is for other sectors. For the electricity sector, we estimate that the coal demand in this year is something around 2.45 million ton this year. And for other sectors, the total demand is something around 1.4 to 1.45 million ton this year. So we can figure out that the total demand of non-coking coal market in China is something around 3.85 billion ton this year. So if we compare the supply and demand, I will repeat the supply figure is 3.98 billion ton. You will find that the coal market, the non-coking coal market, is oversupply in China this year, and I think the result is not very new to you. There is an oversupply volume around 130 million ton about this volume. It's very interesting that you may know that for the Chinese government, for the Chinese government, the Chinese government is trying to increase the coal production in recent years to how to say that? It's a government policy, you may already know that, to guarantee the supply. And for this year's, the increase in volume is just around 100 million ton to 130 million ton. So this game is very interesting. You could imagine the non-coking market of China this year is like the government is trying to add another 100 to 130 million ton coal production into the market. This amount of coal production will mainly go to the long-term contract supply, and it will squeeze out some of the market coal into it will squeeze out around 100, another 100 to 130 million ton of the market coal supply into the market. Here, I'm not sure if I describe this amount of coal as market coal right or not. It means that this amount of coal will not be guaranteed by the long-term contract. It will just directly trade into the spot market. So this amount of coal is 100 to 130 million ton. And if we look into the inventory, especially the inventory from the non-electricity sectors, you may know that for these 2 years, the end users are using a strategy to maintain their production under very low inventory because their profits are not very good or some other issue they feel the coal price was high, all of this. If we can make an assumption that this amount of 130 million ton coals into the inventory system, it can just make the end users' inventory go back to a normal level, go back to the healthy level as what in the past. Especially this inventory is not going to the electricity sector and user sector, it's go to other sectors. So this is where my conclusion comes from at the beginning, that if the end users from non-electric sector decides to replenish their inventory, then the Chinese coal market could be well balanced this year. If these end user sectors do not want to replenish their inventory, then the market is definitely oversupplied. Currently, you know that the price is declining, especially in this month. The main reason is that the end users has not started to replenish their inventory yet. We expected because according to the seasonal behaviors, the end users are usually replenish their inventory from May, from end of April to May at this period. But this year, this not happen at this moment. I talked the issue to some of the end users. The key reason is that they still feel the price a bit high. They couldn't accept the price to start the replenishment. But definitely the end users will do that in future. They will, because they are currently their level, coal inventory level is not very healthy. They will replenish it. The key question is when. I think this is a very complex thing because it's more less like a question whether the chicken go first or the eggs go first. I think it depends on the price. If the end user feel the price is quite right for them to start the process, they will do that. If not, they will wait. Currently, the market still exists in the period they are waiting, and the price declines. This is very reasonable. And this is for the non-coking coal market. For the coking coal market, you will astonishingly find that the story is quite the same. And also here I share some figures for you. For the total coking coal supply this year, we expected the production will be something around 500 million tons this year. And the total imports of coking coal will increase in China this year. We expected the imports will goes to something around 72 million tons this year. So we can figure out that the total coking coal supply in China this year is around 572 million tons this year. We calculate, if we estimate the domestic demand, we can get some figures around 565 million tons this year. So you will also find the same result that for the coking coal market in China, it also oversupplied. The volume is around 7 to 8 million tons. Also it's not weird that the coking coal price also go down recently because it's oversupplied. But if we look into the end users' inventory, whatever from the coking coal plant or steel mills, you will find that their coking coal inventory is quite low. Now. If we also can make assumption that if this 7 to 8 million tons of oversupply goes into the end users' inventory system, we will find that the inventory will go back to a normal level, to a bit healthier level. So we can, for the coking coal, we have the very similar result or conclusion here that if the end users, whatever the coking coal plant or steel mills, when they are starting to replenish their inventory, and when this happens, I believe the coking coal market, the coking coal price will become steady by that moment, and even it has some potential to increase. But before this happens, the market will keep the oversupply feature, and the price might not be steady. And this is just what happened now. And this is my main conclusion here. So my suggestion is that if you want to see when the coal market in China be steady this year, a very important issue for you to pay attention is the willingness of the inventory replenishment from the end users. Yeah, that's my conclusion. Yeah, thank you.
Thank you, two gentlemen. Yeah, very nice figures, very, very specific as well. So we have 572, we have 565 million tons regarding the coking coal. I hear a lot of mentioning of the word normal. So let me just ask my three panelists, how do you define normal for this year? I mean, when we say normal, do we say that the normal will be back to the pre-COVID-19 days? Or actually we are talking about a kind of a new normal? Because to my understanding, you know, the normal, the definition may have changed after 3 years of the COVID-19 as well as the war ongoing. And I have friends in Congo as well. Now they have this kind of war gunfires happening inside the country because of the 2024 election. So a lot of things has been happening globally in the past few years. So can we really say that, you know, for 2023, the market conditions will be back to the normal as we understand, or we need to redefine normal? Please go ahead. From the lady first.
Hi, am I audible? So yes, according to...
No, I don't think you are audible.
Is it better? Yeah. So according to us, I mean, we are definitely never going back to the pre-pandemic phase. The floor of prices has increased. So no matter what up and down we might go to, you know, the volatility we might see, the price floor has increased because I think though energy prices have come down, but most of the prices, if you'll compare them to what they were prior to the pandemic, we are much higher, still much higher. So we think that this is the new normal, or you know, whatever we would like to call it. But I think there's going to be a lot of you know, churn, I would say, in the, you know, macroeconomic space, and sometimes it seems a little distant and it seems little like something that doesn't concern us. But I think these really monetary tightening that's happening, I think that's going to bring some effects in the coming months, and that's what we're already seeing. This sort of demand slowdown where, you know, buyers are not ready to pay, you know, bid the amount compared to the offers. The spreads are huge. We're going to see more of that. So this year, I think, of course, we might not see the fluctuation in price that we saw last year because of various reasons, but I think this high interest rate environment will necessarily constrain demand to a great extent. And that's why I feel, you know, it is going to be a tricky year also. You know, 2020, all the last 3 years were different. And even this year, we would see the effects of it sooner than later.
In my definition, I think we're still inside the seasons, inside the norm that from 2020. I think from 2020, the whole world was educated that people pay less attention on energy, including the coal. Perhaps people from, if we go back to 2020, perhaps by that time people think coal or energy was not very important because the whole world will enter into some new energy area or like area or time like this. But what happened from this? What happened in these 2 years educated the world, and I don't think the educated period will just disappear in 2 years. We are still in this season, in this season. So from by next 5 years, I say 5 years, that we will continue to find that the energy, including the coal, are very important to make the whole world to move to like that. So I don't think the energy price or coal price will just go back to, or the market will just go back to the time where before 2020, the people, the whole energy industry will continue to show its importance in these 5 years. After that, maybe the market could be rebalanced. Yeah, that's my opinion.
So I think we are living in this VUCA world, right? This term which I really like, because each year the component of this VUCA keeps changing, right? So we are in that phase last year where the V was extremely high, the volatility was extremely high, and the ambiguity was extremely high because nobody knew where it is headed, you know. So the V and A components were very high last year, whereas this year, I would say the V component is going to be much lesser. We are probably into a less volatile period, more, I think, but the complexity has increased. The C component, which is the complexity which comes from the macro, what Ashima was mentioning earlier in her presentation, we are into a recessionary phase. We are into a phase where the interest rates are very high. How those things will impact the banks are going through severe restructuring phase, how those things would pan into the overall economy and the overall demand, overall supply, the cost structure. Yes, those are complex. There is no very simple answers to how those will plan out, but the complexity of the world has increased definitely. So I would say the volatility, uncertainty have come down, but the complexity and the ambiguity has gone up. So I would say that this period we are going to probably see less inventories, primarily because one is, as Mr. Wang was mentioning, I think the inventory managers don't know when to restock because they feel there is more downside on the prices. But at the same time, I would say that they won't be sitting too long on inventory because of the interest costs. So what we're seeing in our partners who are buying coal from us, that the time they used to consume or the time they used to lift the coal has reduced, primarily because the interest costs are much higher. So they want to quickly turn it around, keep minimum level of inventories. So those things I would say would increase a very healthy period for coal where you're not holding stocks over a long period of time, raising other technical difficulties on a natural product. So from a coal perspective, it's a good thing. The fresh coal keeps churning around, and that reduces the quality issues overall for everybody. So I think it's each year is its own challenges. I don't think it's pre-COVID normal or anything of that sort. We are in a different challenge currently. It's not a COVID challenge, but it's a recessionary challenge. It's an interest cost challenge. But I think stability-wise, the volatility-wise, I would expect less this year as compared to last year in that sense.
Yeah, I do see the consensus here. Less volatility, low inventories, still uncertainties. Actually, immediately I have another question for Mr. Mishra because last year, Europe actually imported quite a lot of coal. Originally, Europe relied on oil and LNG. So what about this year? Australia will still find a very good market for Europe. Europe will still be stocking up coal, just out of concern, or is
See, Europe has always been playing on the dark spread between oil and gas and coal. So I think that spread is going to be critical how they are going to operate in future because uh, technically they have the power plants which can switch between both, which is not the case in Asia. But I think Europe is designed that way. So as long as the low gas prices prevail, I think which is currently it is, Ashima showed in her presentation, I think this is a regime of low gas prices. But once it changes, again, coal will have its play. But again, if you look at the first quarter of Europe, the coal consumption has been pretty much similar to last year. It's not really changed. So drawdown has been mostly from inventories, so that's why you don't see that much of trade flow into it, but the consumption of coal has not reduced in the first quarter of this year. So I would say that Europe has realized that they cannot be only dependent on one source of energy. Each country is trying to find its balance of energy mix going forward. Some are thinking about nuclear, some are thinking about gas, some are thinking about renewable, how to increase it more speedily in the coming days. But I think they have realized, and I think the energy importance of energy, as Mr. Wang mentioned, has been highlighted very well in 2022. That the world has come to realize that it's very easy to wish away coal, but at this point, the unfortunate truth is we don't have a reliable alternative to coal. So I think that's my take.
Thank you. What you did mention is about this. Every country is reviewing its stability and security in the supply chain, in the industrial value chain, and everything. And actually, I have another question for Ashma as well as Mr. Wang. What do you think of China's economy? Do you think, like, China's economy? Do you think the world actually is ready or kind of accepting the reality is that China is slowing down, looking for the quality development instead of the quantity development?
Firstly, I'm sorry that I'm not a specialist in the economy. Definitely, you are right that I think China will go to that route for the high quality development. A very important reason is that if we only look into the quantity, the market in China, I don't think the market in China has a very good potential, great potential to further increase. But for the quality side, I still believe that there's still a lot of room for China to improve in future. And also, I think government also find this. And the Chinese government, year by year, the Chinese government will find a way to move the whole country forward, to find the increasing point to make the economy to grow. And I think that's the road for next 5 to 10 years, that the whole China will switch into this road, the high quality development route. I'm not sure if it will influence or have directly impact to like the Chinese coal demand or coal market. Currently, I don't think there are a very tight connection or relation between these two. Even the China will step into a high quality development road. The coal resource or the coal market is still number one important market in China. That's my opinion. That will not be changed in 5 to 10 years. That's my opinion. Thank you.
Ashima?
Again, China is a difficult question to manage, but I agree with what he mentioned about, I think China now really, I think they came out with a dual circulation strategy in 2020, which meant that they are going to look internally, they are going to look at domestic consumption growth and not look at external market, because I think 2020, China was relatively better off than the world, and they felt that they need to look more internally. And I think going forward, the hardcore infrastructure, which involves steel and coal and cement, will pave way to the softer infrastructure, which is AI, 5G, telecom networks, and chip building, and all of that. So, I mean, we've not seen the property sector, which, as I mentioned, was the mainstay of development, and with news of Evergrande and other property developers coming into a debt trap. It seems like that traditional model of development will now pave way to something different, and which is the future for, I think, global economy as well to some extent. But I think that growth of urbanization that we saw previously has been achieved to a considerable degree, and there's a level of saturation in the property market also. So that's why I think they will find innovative ways to boost the economy, not necessarily the way through building huge bridges and roads, but something which is more in tune with the environment that we are in.
Thank you for the answers. I'm mentioning this because this year, so far from the media, again, a lot of media reports focusing on China's rebound from the reopening. But I think we do need to rethink what kind of role China will be playing in the global economy, as well as in various commodities, because we are no longer in the old days. We are very much in the transitional period and the new days. But having said so, again, I do notice that China and the rest of the world, again, we're talking about a green economy. So green economy after 3 years of COVID-19 is very much back in the picture again. So I want to just ask on my three panelists, what kind of impact this will be on this year's economy. Like Europe definitely will be looking into the carbon tax again. China, I think I give you a very comfortable topic about steel production, steel demand. And Ashima, you can just pick up, which part you feel comfortable about this kind of a green economy and green development, whichever, sector you feel that will be having the impact. Yeah, please go ahead.
Yeah, I think green economy is the way forward. Everybody agrees to that. Every country has set its own years by when it will be carbon neutral. I think if you look at yesterday, I think people are talking about India's steel sector, right? So India's steel sector has set itself very ambitious target as compared to the country. Country is talking about 2070, whereas steel sector is talking about 2047 or something to become carbon neutral. So I think each economy, each sector of the economy has set itself certain green targets. I think what we have realized during the last 12 months is that energy is an important question for the whole world. I think the transition towards green will be even faster because people have realized that they cannot delay it anymore, and it's going to be even more investments probably going in that towards renewables. We are seeing clear direction towards hydrogen in most of the countries. We are seeing a lot more cost-effective solar and wind power coming out in most of the large economies. You are talking about almost 30-35% in most of the economies now reaching to solar and wind based power. But I think the big picture is still not clear. Hydrogen, does it answer? Partly, yes, but I don't think it is still a big answer to replacing the fossil fuels. So I think what is that big alternative is still in the horizon. People are looking for answers, and I would say more and more investments and more research and development will go into that. The people are writing of coal by 2030. That looks a little early for coal to demise. I would say we have still got coal another lease of life of 5 to 10 years. But yes, the road forward is inevitable that we have to go towards a sustainable planet, and that's the aim for everyone.
Yeah, sure. For the green economy, my opinion is that both China's steel industry and also the coal industry are not separated from this strategy. It's in contrast, it's a very important part of this green economy strategy. Of course, China will continue to push the carbon road in the next 5 to 10 years, and both the China steel mills and also coal industry are very important part of this, a very important role in this process. Typically, let's focusing on this year. You may already heard that the Chinese government will continue to control the steel production this year. You may hear some sayings or rumors. I don't know that the government doesn't allow the steel production to be higher than 2022. I also had some resources to get this kind of info, and I could share to you that also the government was in a dilemma at this moment, because you know that the government, the China's economic behavior was not very good in 2022 because the China was reopened later than other countries. So in this year, the government also will consider a lot of issues like the GDP growth, like the labor problem, And for the steel industry, it keeps a very important role in this kind of local economy behavior, and also the labor market. So the government will be very careful about the political control on steel production this year. It might more pleased to see the steel mills control it themselves. So the government just put this target, that production will not be higher than last year, and other jobs are done by the steel mills, by the companies themselves, not by the government. That's my thing on this.
Yeah, I think most of the points have been covered, but from the cost perspective is what we look at. I think the decarbonization drive is actually adding to costs for companies, and that's an inevitable cost that will also seep through, and that's why we say that prices will never go back to where they were pre-pandemic, partly because of the investment that is required to invest in a green economy. Plus, things like supply chain diversification is also something that companies are voluntarily doing to build resilience in their supply chain. Again, they had very strong supply chains in China, but now again, for instance, Apple is making iPhones in India, but again, to set up the whole supply chain, it really, adds to the company's costs. So I think these things are inevitable, yet, they are adding to your bottom line. Yeah.
Thank you. Because we start like 5 minutes later than behind the schedule, so we kind of end, instead of like 11:15, we're ending at 11:20. So that's a plan. And thank you everyone for being here. And the whole theme of the panel discussion, you may notice that I haven't really focused on specific commodity. What I want to do is it's more like kind of, brainstorming. So instead of like, people do need to think from the high profile thing, from the overall economic thing regarding particular commodities, because I do feel that 2023 will be very much a transitional period. This, we can't really just focusing on specific in commodity. We need to look at the global economy, geopolitics, and also supply chain security and everything. So that's the whole point of having those questions. It may be looking like kind of scattering around, but hopefully that will be bring some like kind of thoughts to everyone.
Questions for them? Sorry. Some questions from the audience? No?
Sorry, I can't really take questions from the floor. If you have questions for specific panelists, please just approach them because we are running behind the schedule. Okay. I'm so sorry, because today we have quite a tight schedule. Thank you, everyone. Thank you for the panelists.
Thank you for your
and
patient listening. Yeah, thank you.
May I ask Mr. Handras Sinadia, Executive Director of Indonesian Coal Mining Association, to pass on the token of appreciation to the panelists. Thank you, everyone. Thank you all. Thanks. Immediately we are going to the second session, which is talking about the freight market. And before we go ahead with a panel discussion, again, we have a presentation to deliver by the Bulk Marine Hong Kong. So let me introduce the speaker, Captain Sanjeev Bhargava, CEO of Bulk Marine Hong Kong. So Captain Sanjeev Bhargava is the CEO of Bulk Marine Limited, a well-established entity in dry bulk shipping. He has a vast experience of sailing on dry bulk carriers and running chartering desk for an established trading house. Bulk Marine Limited was established in 2003 as one of the foremost dry bulk shipping operators in the Asia-Pacific region, engaged in transportation of coal, iron ore, bauxite, clinker, aggregates, fertilizer, etc. The company is also engaged in providing commercial and technical engagement to its clients. Please.
Thank you, Hong Mei, and good morning, everybody. And thank you, Coleman, for inviting me to give a weather outlook. Sorry, not weather, shipping outlook. There's not much difference anyway between weather and shipping outlook, you know. So some wise men said once, like, it's better to be quiet and keep your mouth shut rather than opening it and removing all the doubts, you know. So here I am trying to make an attempt to open my own mouth about shipping outlook this year. We'll talk generally about global economy and then talk about a little bit on Chinese economy and then get back onto the basic supply and demand model. You know. So there's a geopolitical tension and protectionism are threatening to depress the global freight growth and financial stability, as we have seen from a previous discussion. You know. We are yet, one of the things which the House hasn't addressed is there is a general new term that's trending in the market, which is called friendly shoring. And this is essentially dealing with foreign direct investment from one friendly country to another friendly country. And as we see recently, there is a big divide that's going on between, due to the Cold War between US and China, where, you know, we see Saudi Arabia, Iran, and countries like Russia and Brazil inclining towards China and the rest of the world, and US and Europe on the other side, you know. So this is this a clear evidence of deglobalization and a decoupling between US and China? You know? So this is a very important factor which probably will dictate what happens to global economy this year. You know? So economies that are likely going to get hit by this is some economies which are in between the two, you know. So that might hurt their growth prospects, you know. Finally, Russian war is also disrupting the supply chain, as we all have seen so far. WTO export forecast is going to be slow to 1.1 against 2.7% in 2022. So clearly there is a evidence that the growth is going to slow down, you know. And IMF has also warned of hard landing if inflation keeps interest rate for a longer time, you know. And as we can see, Fed has got it all wrong as far as interest rates are concerned. So finally, it's very difficult to accept any argument against a recession, you know. Sorry, just have to consult my notes. So now coming back to Chinese economy, which really is the important elephant in the room as far as dry bulk shipping is concerned, because 50% of all the global trade in commodities is basically owned by the Chinese, you know. So the Chinese GDP came to 3% last year in 2022, and the forecast is for about 5%. So obviously in that 3% GDP growth, everything was down negatively, the oil, the gas, the coal, and the iron ore, you know, they're varying from 1% negative to 10% last year. So what is 5% GDP has got to forecast? What do we take into account? And then obviously market is very upbeat about the commodity prospects on the backdrop of this 5% growth, So this breakdown of China's 5% GDP is clearly defined into three sectors. One is the infrastructure and construction. Secondly, it's domestic consumption. The prospects of exports look very bleak in case if there is a protectionism that comes into play, from Europe and US, especially on the steel side of steel exports from China. So just to give you on 22 imports, gas oil was down by 9.9%, natural gas was down by 2.5%, iron ore was down by 1.5%, and coal was down by 10%. So it's from that level, if we see 5% growth, it's not much for commodity in there, the growth in commodity. Now, this year, we have already seen 300 million tons of iron ore imports so far in this quarter, and about 100 million tons of coal. So, China recovery appears to be on the track, but one has to think: is this a front-end loading? And considering what we have heard from the previous panel, there is a general slowdown. So 300, it's like. What should I say? It's like a revenge spending from the steel mills, So normally what happens, the infrastructure and construction season starts after winter, which is now April. So they have been basically ordering raw materials in the view they can make some decent margins on the steel, But if the consensus is the market is going to slow down, we see probably the market will slow down in next quarter, And then gradually, it'll be just in time, like inventory approach to the whole process of the market, if the prices are falling, as suggested by the previous panel. So this is in short, and the next big thing, which is very important for dry bulk market, is India. And thanks to cheap Russian oil and coal, the economy is doing pretty well at about 7%. And of course, the Indian coal market is very price sensitive, and every time when Chinese are in the market, Indians like to take a back seat, and once they go out, Indians start buying. So, but this time around, things are a little bit different because the emphasis in India is on infrastructure, where they can't do these kind of getting in, getting out of situations. But all in all, the coal markets are looking very promising in India, and especially we see going forward. We expect the thermal coal market to slow down, and coking coal market should increase by 25, 30 metric tons by next 2-3 years in the light of a promising steel sector in India. Can we move on to the slides, please? Oh gosh, I can't read this. Okay, so our forecasts, our basically outlook is depending upon low case, base case, and high case. And I won't really go on to the base and high case after hearing from the previous panel. So let's stick to, we find inflation will respond slowly to monetary policy measures, and recession will be a part going forward. Maybe it's right now, but it looks like US is heading that way. So in the low case scenario, the bottom two are 2022 is the average rate, which was 18,200 for a handy size. And now our revised forecast is about 12,700, 13,400 for Supramax, and 14,700 for Panamax, and 17,000 average for the remainder of the year for Cape size, Okay, we have already discussed about the economy. General consensus is this economy will slow down this year before it gets better next couple of years. So we are basically trying to give you an outlook for this year, not going forward. Our forecast is based upon China PMI, China production PMI, and China in India investment as a percentage of GDP. So as you can see, investment in India is going up primarily because of the infrastructure, and Chinese investment is coming down. Okay, let's get to the. So on the dry bulk demand update, the total trade in last year was negative 2.7 as against 1.92 this year. So there is a gradual trade volumes are affected by the war in Europe, slowdown of Chinese imports, and weaker global economic sentiments caused by surging commodity prices, especially those of food and energy, gradual shift in coal grains, and minor bulk trades put together to longer haul routes gradually inflated ton miles and moderate to decrease in the volume. Total dry bulk trade in 2023 is projected to grow by 1.3% in tons and 2% in tons per mile. That we'll come back to next. So as you can see, global iron imports are not really going to grow too much. As I understand, there is what I have heard about is there's going to be a 2.5% reduction by the Chinese on the steel demand, on the steel supply in China. That basically equates to this year about 900 million tons of steel produced. Out of 900 million tons produced, you have to notice that 30% of that steel goes into the construction sector. Now, if we are going by anything by the real estate, which contributes about 30% to the Chinese GDP, you must have heard about recently that Chinese property market is doing well. But what appears to be the case is Chinese property banks are giving away loans, and which I understand is below the level of the mortgages which people have to pay. So those bank loans are being taken by people to service their own mortgages. So it's not really going into the actual economy. So that may be one of the reasons why they want to reduce the government wants to reduce the 2.5% steel output, this year. So the if you see the inventory levels are also reasonably stable at about 140 million. Now, if you compare the prices of iron ore, it started with about 133 this year, and if I'm not mistaken, last week it was $115. So there is a clear trend that the steel mills are pretty much stockpiled for the first quarter, and then from there on they'll probably go as and when they require the inventories. And also, interest rates are playing. During a high interest rate regime, commodities prices appears to be heading down south more than the north. So we expect about pretty much at par, the iron ore imports this year. On the coking coal imports, the major, I think, probably the growth story comes from India, and obviously China will be as Mr. Wong said, there'll be about 70. And if I'm not mistaken, we are heading about 120 metric tons, million tons of coking coal in India. Okay. And as I said, I think Indian steel sector is doing very well, and we see about 25 to 30 million tons coking coal added in next 2-3 years. So coal ton miles expanded to 1.8% in 2022 and is projected to grow at 4.2% for 2023. Sanctions on Russian coal have reshuffled trade routes, boosting ton per mile. But one thing I like to say this year, there is a more tonnage in Atlantic side, so that any increase in ton per mile. Sorry. So it's very unlikely that you'll see an increase in any ton per mile growth. Especially we see this Handymax, Handysize, and Panamax are present more in numbers than usual in Atlantic this year. So we don't see that ton per mile story is going to sell, at least for the time being. That'll increase make any upside increase in the freight market. When it comes to grain, tons per mile is contracted negative 3% last year and is projected to grow by about 5% in 2023, following supply shock caused by the war in Ukraine. There is a big crop in Brazil this year. However, because of the weather, that gets delayed. So we probably see the market bouncing back a little bit in the second half of this year. When it comes to minor bulk, the ton per mile contracted 3.1% in 2022 and is projected at 1.3% for 23. War in Ukraine has disrupted the European market fertilizer trade and steel production. Atlantic steel shortages are incentivizing the Pacific exports. But this year, probably because of the protectionism, we haven't seen anything as yet. But that could decide the fate of Chinese steel export into the European markets. Okay, this is more. The supply side is more important, interesting this year. As we see, the supply and demand are very evenly poised. There's hardly 1.7% growth in the cargo side, in the demand side, and the supply side, the new buildings are very limited. It's supposed to grow by 6.7%, but the net fleet after demolition and the slow speed, we are looking at the supply side going just under 2%. So you can see the two. There is a balance in supply and demand. And the reason why there is no new building, I think since yesterday we are hearing because of the decarbonization requirement, there are no new building orders. And the earliest you can today, if you want to contract a new building, essentially the yards are full for next 2 years. So nothing happens till 2026. And that too, there are two things. The tonnages are very expensive right now, the new buildings. And secondly, the cost interest rates are very high. So if I was a ship owner, I'd rather pay my debts today than try to buy a new ship, at the moment. And obviously, because of the lack of future visibility on the future fuel, people are not ordering ships. So this situation is going to be very tight for next 2-3 years. We don't see the net fleet growing by more than 2%. And of course, the speeds are all down now. We are all, they all factored the slow speed, which is a part of the XC, as you must have heard yesterday. They're all factored in pretty much, So, and that happened essentially, the rule came into from 1st January 2023. And essentially, the price of fuel actually forced them to do that before actually 1st January 2023. So you must have seen for the last couple of years, all the ships are basically operating at reduced speed. So the order book we have already discussed just now that there's only 2%, 6.7 growth, and going forward that is still less in future. As it's not here, we don't have a forecasted, but we don't expect more than 2% net fleet for next increase in net fleet for next couple of years. So going forward, I mean, as I said, the market is evenly poised, and demolition will probably control the supply side issues of the fleet. And there is one important element which could basically change the freight, that is congestion, which I don't think is going to come back as we had it in 21 and 22. But that the market is so evenly poised that if there is a one event that can disrupt the shipping, it's possible the freight rates can go up. But nothing like what we have seen in early 21. So I would reckon the market probably will go up by 10, 15% if such an event happened. And the other interesting aspect going forward, once again on the supply side, is 19% of the fleet is over 15 years age. So somewhere down the line, the more established charterers would basically avoid taking ships, which is already a trend in the market, that they will not fix ships over 15 years old. And probably their decarbonization policies will prevent them from taking in. So these are a couple of factors which can affect the freight. We already discussed the IMO regulation. The implementation of IMO will be affected by the two regulation XC and CII, which have a different impacts on supply, affecting average vessel speed and demolition. So if the market continues to go down, I have a feeling the demolition rates will start picking up. But as long as the reason demolition also starts coming into play is when the vessels have a special service, the 20, 25 year, which really these survey costs a lot to carry out, about between $2 to $3 million for the repairs. So at that time, it becomes a commercial issue with the ship owner whether he should dry dock the ship or demolish the ship. So that's a decision. It's all based upon what happens to the freight market at that point of time. When the ships are due for dry dock. As I said, most of the dry bulk ships are basically operating at a slow speed. So that is already factored into the net fleet position. Okay, most bulkers are non-compliant at 75% MCR. Therefore, all of them have to operate at below 75% MCR. So MCR is basically, it's a maximum, maximum continuous rating, that's what it is. So you cannot just reduce main engines at sea at any speed. They can. There is a minimum requirement by structurally at what ratings you have to perform from the ships. But having said that, we are basically all the ships are complying with it right now. The slow speeds, and there is a classification requirements. They put a they put kind of a speed reduction devices on board, which cannot be touched by the crew. They have to take permission of the classification societies to change the MCR rating of the ship. So as we speak, the following ships are actually going at maximum speed, in the market. So it's a majority of the fleet is already steaming at a slow speed. So to summarize, recession fear is still a major concern amid weak macroeconomic conditions. High interest rates are not good for commodity markets, which will likely to compact continued recovery of dry bulk market. Reopening of Chinese economy, we have already discussed, and forecasted developments India will support the market. Probably those are the only two markets which will hold, and any other market doesn't make a big impact on the dry bulk market. So trade flows which were altered by the war are unlikely to reverse in short term. As I said, although Europe looks very good in terms of energy supply for rest of the year, but I don't think that they will be closing down their coal-fired plants so soon. They probably wait for the war to get over before they try and reverse that operation. So regulatory background, as we had discussed in XE&CI, will prevent the fleet from growing, and we don't see much changes in that side in the medium term. There is another thing which is, on the decarbonization, which is very important to look, is on the supply side is it the supply side or the end user who's going to change this game? We already see, like, they were talking yesterday, BHP is closing down the coking coal mines. So what are the new materials which will, going forward, it'll be probably anything to do with the decarbonization elements, such as copper, high-grade iron ore, aluminium, cobalt, lithium, etc. So going forward, what is the future for coal and all? We see the coal is already seems to be appearing to be peaked in major countries like Korea, like Japan. India and China will remain the two major users of the coal, which will drive the bulk market. Europe and US probably will do so only in times of extreme circumstances like what we witnessed last year. So with that note, I would like to conclude my session. Thank you. Sorry.
Thank you, Mr. Bhagavat, for giving us the overall picture of the demand and supply in the freight market. And now we are going into the panel discussion, and then allow us to move the chairs and table to the center. Let me introduce my other panelists, which is Mr. Wilson Virawan, Maritime Analyst, Dry Bulk Team Lead, BRS Shipbrokers. Mr. Wilson has the dry bulk research and intelligence portfolio in BRS Shipbrokers, an international shipbrokering firm with 20 plus offices, which has been servicing clients since 1856. He has played a major role in expanding the BRS dry research portfolio to include iron ore and steel, coal and grains, alongside spot freight, FFA, and fleet analysis. He was recently invited as a panelist speaker of Brick Wave Day 2022 dry bulk panel, which explored the dynamics of dry freight, the Ukraine-Russian war shock, and China's impact on the market. Mr. Wilson holds a bachelor's degree in maritime studies and business from NTU Singapore, and a master's degree of science in energy, trade, and finance from Cass Business School, London. Sorry, I forgot my microphone. Thank you for the panelists to join me. Before actually I start my questions, any questions from the floor? I'm sorry, I didn't really open the floor just now. If you got any questions regarding the free market, please just go ahead and ask. Anything? Lovely. Can we just pass the microphone to the gentleman? Please just raise your hand. Yep, thank you.
So I have a question to the gentleman who just gave the presentation. You said the owners have a decision coming up whether to scrap the vehicles or to maintain it and refurbish it. So what do you think the possibilities are in the upcoming months or years of more of the vessels being scrapped, like percentage wise?
Yeah, coming to your question, there are two reasons for demolition of ships. There are regulatory requirements which probably prevent them from running. Secondly, when they come to an age, it all depends upon the market conditions. If owner is making money over its operating cost, he will continue to run the ship. Although what happens is when the ship gets over 20 years, basically they will have a limited trading abilities. You can't go to, let's say, if you want to go to Australia or you want to go to South Africa, you are restricted by the age of the ship. Now, as long as he can find a decent employment which is giving him a profitability over his operating cost, he will run it. But what comes at a time when he has to dry dock the ship for special surveys after 20 years, it costs a lot of money to refurbish that and to comply with the special survey cost, which can vary from $2 to $3 million. So if that cost is prohibitive for him to go and do the future business, he'll probably scrap the ship. So that's a simple commercial decision he has to take at that point of time. I hope that answers your question.
Just a follow-up to that. The reason why I was asking was we have a shipbreaking yard. I'm from Bangladesh, and we do a lot of shipbreaking. About 70% of the ships that go for scraps go to Bangladesh. So that was my main intention. That do you see a trend of more ships coming up in the few months?
No, see, there are two things right now. One is the regulatory requirement of XC and CII, and if going forward as they are painting a picture where the freights are going to go down because the demand is commodity demand is going to go down. So obviously the market, his returns on his ships will probably go down. So that is the time we will take a decision. Let's say today you have to decide whether I want to take the ship into dry dock or not. You will see probably a forward market for 1 or 2 years and say, okay, I'm willing to spend $3 million, refit the ship to be able to be in the business for next 3 years. And if he can't make that $3 million in next 3 years, he's not going to. He says his decision will be to scrap the ship. So that's a very individual thing, with the owners.
Okay, thank you.
Before we go ahead with other questions, Wilson, do you want to give us a few highlights regarding the global free market from your side?
Thank you very much for inviting me. So with regards to the overview of the freight market, basically entering into this year, there's 3 main narratives, or 3 C's, I would say. First is the level of congestion. So in the last couple of years, we've seen congestion in Q2, Q3 2021, peaking, going up high and high. to unprecedented level. And that's because of the Chinese authorities back then, due to the zero COVID measures, put quite draconian measures. And we start to see Capesize, Panamax, Supramax waiting their time there, because what happens is the Chinese harbor pilot, you basically work 7 days, get quarantined for 7 days, and then you rest for another 7 days. So that basically limits the availability of pilotage, which to lead the vessels to the berth to discharge. And what that creates, it's a very tight supply squeeze that allow ship owners, the vessels that's plying outside of the Chinese port water, they give them all the leverage. And when ship owners have leverage, they certainly are not shy in using it. And one of the prime example was Capesize C5TC, went from printing $20,000, $30,000 per day to $40,000 per day, and at one point exceeding $80,000 per day by the time we reach October. So what I just want to mention is that congestion, if at significant level and for a prolonged period of times, can really be an effective lever in jacking up the freight rates. And consequently, if the congestion level were to go down and stay at somewhat flattish level, then its implication on freight upside will be limited. And this is exactly what we've been seeing in the first 3 months of this year. So Capesize, for example, Capesize congestion has gone down quite considerably, and is now back to 2016 to 2017 level. And the next C will be China reopening story. So of course, China went from zero COVID to total COVID since last November, and that really cleared the pathway for the dry bulk appetite to return. So it's a no-brainer. The question is by how much and how fast. And so far, the 3 months data that we have has been quite encouraging, at least from the ship owners' perspective. So China dry bulk receipts have increased by 16.7% in Q1 year on year. But the question is also, despite this increase in dry bulk receipts into China, the Q1 year on year freight performance have also declined. And that's because we have the congestion that really put a dampener on the effect of dry bulk volumes coming in. And lastly, we have container. So I believe that we all still remember, like just a couple of years ago, container rates just also went sky high. And that caused the concern of the US government, even like US President Joe Biden. And when we have container rates going that high, so a lot of the shippers, they have to find alternative solutions. And one of the solutions is to charter in the smaller size vessels, the geared barkers. We have the cranes to load and offload the containers. So moving into Q4 last year, the container rates, be it the box rates or the charter rates, have collapsed near to the pre-pandemic level. So that means that the additional tailwind that we've been receiving for small size vessels, that allow the small size vessels, let's say the Supramax and Handysize, to track $20,000 per day, that tailwind is longer there. So these are the 3 main factors heading into this year, and has already been in effect for Q1. So that's it.
Thank you for the very high profile sharing. Any questions from the floor? Carry on, please.
The question is, how do you see the Cape freight, going ahead in Q2?
So basically, that has to goes back to China's demand, because Capesize is basically iron ore and coal. And you look at China's demand, so this is basically just my opinion. If the GDP target come out 5%, if you know your economics 101, right? So basically it's consumption, investment, net exports, and government spending. Consumption is pretty weak. We have seen the numbers out there, also on the floor. The People's Bank of China recent survey come out that still it's a lot of people is more still willing to save rather than spend. And in fact, after the COVID has reopened, we move on from zero COVID, the willingness to save is even went up. So that is really a suggestion that congestion is weak. Consumption is weak. Then investment, we have domestic and foreign. That is also pretty bad. And exports-wise, no need to say. So with consumption weak, exports lean, and also investment is also like a lean. So what is really left is government-led infrastructure spending. But the issue is quite well documented that China provinces are in budget deficit. So you cannot raise tax, so you can only raise debt. So that's why we've been seeing so far why infrastructure spending and the IMO volumes coming to China have been increasing. But that's basically mortgaging your future for the present, and that future is already, in my opinion, is already looking quite shaky, because if we look at it, even while we move away from the zero COVID, a lot of the issues that were previously swept under the zero COVID policy is now need to be tackled by the incoming new administration, such as unemployment among the youth, an ailing property market, and also, and most importantly, a deficit of confidence. So there's a deficit of confidence, what we feel from the consumer, from the enterprise, and most importantly from the foreign investors. So yes, so in the next few couple of years maybe, China, in order to pull up the GDP growth, they will definitely need to do infrastructure spending. But 3 years down the road, maybe 5, 6, 7, who knows? Then we have to monitor. And with that said, coming back to your question, we believe that China's recovery, and by extension Capesize recovery, should be an L-shaped recovery. So with the upside, if any, to happen, it will be earliest at Q3. I think we are one of the few brokers out there that immediately rule out a V-shaped recovery. By Q1, we will see an immediate upturn. And I think a lot of people were disappointed when Q1 come up and they deferred their expectation, their bullish expectation, to at least Q3. But at the same time, I wouldn't be surprised if by Q4, the recovery will come in. Because one of the biggest lesson that I learned from the last couple of years is that shipping is basically a seasonal market, right? But as we move to this new normal, as what the last panel have discussed, a lot of the seasonality cannot be used as an effective indicator for future rates. So for example, in last year Q3, everyone was expecting when Shanghai lockdown will be passed, we passed that phase, there will be a post-Shanghai lockdown boom. And a lot of people went long positions into freight in expectation of a Q3 rally, but that didn't happen, and a lot of people got burned subsequently. So that's my view so far.
Thanks. So it's like weak.
So I would
Q2 seems weak.
I would think it's somewhat flattish because the iron ore margin is still pretty horrendous to say. So as a lot of people have mentioned, a lot of the demand of iron ore has been speculative in anticipation of that rebound. But in the end, I think money talks. If you're not earning that much money, there's so much more you can push. And I think also going back to last year, Q3 2022, there was the absence of the freight rally, and that coincided back then when Chinese steel mills were first time went negative. And this year we started the year negative for the steel mills. So all in all, that's the view forward.
Thanks a lot. Thanks.
No problem.
Any other questions from the floor? I realizing like I'm overrunning the panel a little bit, so I will give another like 5 to 10 minutes to this panel discussion so that we wouldn't be kind of a delay the further sessions. Any questions from the floor? If not, actually, I will just ask my question. Yeah, just now, actually, Captain, you mentioned about the decoupling as well, globalization. Basically, a lot of discussions about, because of the security of the supply chain and everything, a lot of things about regionalization and people even thinking about localization. So I want to ask the two gentlemen, what do you think of this? Will this be a trend, or is just a kind of a panic in the short term and everything will be back to normal? Because after all, global trade is needed by every country. Can we start with the captain first?
Yeah, I mean, it's like anybody's guess, you know. I mean, it's like Ukraine war. He was supposed to go in there on Tuesday and, you know, finish it by Sunday. It's never really happened, you know. So the war is one of the things which probably we don't know how long it's going to go on, you know. And obviously, U.S.-China relations are really escalating day by day, you know. So, you know, it's a clear sign there's a deglobalization going on, there's a decoupling going on. The next thing what you have in the market may be protectionism, you know, that people, Europe will find its own steel, you know, and everybody is shifting to green on the European and American side. It's not so much in Asia right now, you know. So I think it might be just turn out to be it's very regional intra-Asia Pacific business will do well. And, you know, if that is the case, then you have a ton per mile will become smaller, and you know, it'll probably put pressure on the freights, you know.
Yeah, just to add on a bit, I believe since the US, actually we could date it back even further, I think since the US-China trade war back in 2018, and then you have the COVID, and then you have the Russian invasion of Ukraine, and of course you have the US-China conflicts on all fronts, not just economic, but also technological and also social. I think that have changed the course of globalization as we know today. But I think it's more of a rationalization of globalization because back then when I think Adam Smith, when he wrote The Wealth of Nations, I don't think he would ever foresee a country like China, such big size and skill, to be able to displace a lot of its competitors' absolute advantage and comparative advantage. So I think it's just going back to a more rational sense of globalization, not putting all your eggs into one basket, and all these basket must share similar values, or at the bare minimum have the desire to safeguard the current trading international rules. And also economic interests can only be safeguarded if it's on the foundation of national security. So I think some countries will be hesitant when doing business with China, but in the end they will still have to catch up also. But I think all in all, this so-called decoupling, maybe by some countries with China, even that were to happen, it's going to take some time because the economic ties is just simply too deep and complex. So this unwinding will be slow and painful. But I think eventually it should materialize to a certain extent. I mean, if you remember back in the 1960s and 70s and 80s, I mean, if you remember that 4 Asian tigers were able to transform their economy by selling their manufactured goods to the Western societies. But it doesn't take more than a decade before we see more of them moving to China, and now from China heading to India and Vietnam. So that's kind of my opinion moving forward.
Thank you, thank you. And actually, the follow-up question is because of all the changes in the global trade, potential changes in the global trade, because it's not the trend yet. What do you think the impact will be on different vessel sizes? Because we do have like kind of smaller vessels for shorter, shipment, whereas longer ones for long haul shipment. So are they having any impact on like handy size, even Cape size as well? What other vessel sizes could be benefiting or kind of losing out in the game?
Look, like as yesterday, one of the gentlemen was, giving an example of a Pilbara ore, Now, if under the decarbonization, you're only going to use a high quality iron ore, what happens to the rest, Now, the rest is probably going the hot, what was that word they used? The DRI, this thing. So basically, if the DRI comes, we have another issue. DRI is not easy to ship, and you require a special types of vessel, So if that is going to increase, we see a reduced role of Cape size, and then probably, so these are very circumstantial. I can't say it, so we have to take example by example, And obviously, there's a lot of EV material that's being generated. We don't need big ships for that, We are looking at handy sizes, So, and the freight is probably not much of a problem in these things. If you look at the price of EV materials, freight is a very small element of it. So whether you do it on a Cape size or handy size, Cape size is not going to happen. So handy size freight, if increased, I don't think it's going to matter significantly, So, I mean, if you break it down, I think, similarly, on the Brazilian side, if you can't add value to a higher value to it, probably, either the steel plant starts shifting to Africa, where there's no problem with these, environmental regulations, So, or probably we see Chinese steel mills, we can already see there is a movement of Chinese manufacturing going into different countries, and it's not their choice. I believe the customers are asking, you have to just get out of China. We will support you as long as it's not a Chinese manufactured good, So the Chinese are moving. Like yesterday we saw there's a lot of met coke set up in Indonesia. So, similarly, there is a big presence of Chinese in these source of origin like West Africa, where you're doing bauxite, Now, aluminium is a big guzzler of electricity. And if so that part can be basically generated there. So what I'm trying to say is there is a possibility that this will move to areas where there are no stringent requirements, for environment. Eventually everybody may have to do it, but you're just kicking the can down the road. Okay, if I can't produce here, I will do it in a more convenient position, So there could be a shift, and that will dictate the nature of tonnage you require.
Yeah, so I think basically we can break it down to China and India. So China, in the short term, what we've been seeing is a quite interesting phenomenon. So China have been importing a lot of iron ore, so that benefit the Capesize. But at the same time, due to the poor steel margins, we are seeing all the surplus inventory that cannot be digested by the local economy is being sent out to other countries on Supramax. So basically, that provided a lot of backhouse support on the Supramax in the Far East, and also moving forward. So if the decline of China and also maybe the rise of India in terms of supply chain moving and that affecting the GDP growth, I think India will eventually gain more influence in making a difference in the dry bulk market. But I think it still be a long way before it can eclipse China's influence, because just in 2022, China's import volumes is around 1.95 billion metric ton, but India coming as a distant second, and took in only 0.33 billion. So that's still a far distance before India can catch up. But nonetheless, I think India is still a very unique actor in the shipping market, because geographically speaking, India is in the middle of the Pacific Basin and Atlantic Basin, and the Suez Canal, which lead to the Black Sea region, is just at its doorstep. So it's also an intermediate stop before vessels head to the ECSA to get the grains. So whenever India choose not to export or import, it will have a deliberate impact on the front haul and the back haul rates and the repositioning options that ship owners could have in the future. And I think one of the main reasons why freight rates going back to last year in the first half of 2022 before it started to decline is that India during that time was buying tons of coal from Indonesia, and that pushed up the backhaul rates and make this route into a primary money-earning leg for ship owners, while in the past it was usually loss-making. And and politically speaking, India have shown that they can say to a certain extent no to the Western imposed sanctions. So it's not just oil and gas, but also, let's say, and coal. But it's also fertilizers on the smaller size vessels. And demographically speaking, India has now surpassed China. So just as in terms of the population growth. So I think all in all, this bodes well for India. But like I say, India is still at a distant second place in terms of imports compared to China. So that might take some time to materialize.
Thank you, thank you. I have just have my very last question before we end the session. Regarding just now, both of you mentioned about the environmental protection. And also, I know that for the bunker fuel, they are supposed to use a lighter and a sweeter fuels, just lower down the sulfur emission. And plus, I noticed that a lot of Australian iron ore mining companies go for so-called clean energy vessels. They're using LNG fueled vessels, all those. Do you think this kind of a trend will be, in a way, supportive to the free market to some extent? Or at the end of the day, the free market is still very much a demand and supply game?
I think the irony of having, let's say, what you're talking about is LNG gas propelled ships. The irony is they're carrying coal on these ships, which is not a, which is a carbon element to it, So these people are already, it's just a step they're taking to be a little different, but immediately I would say it's a greenwashing process, They're just trying to be different, That's it. But it'll take time for these things to settle down, And because as I understand, there is a little premium to these ships, which they are paying, which at the moment I don't see, many takers for that, Because see, the problem is you're selling iron ore to China or you're selling coal to India, Both these countries don't really care about environment for the time being, So what is the purpose of putting a clean fuel on a ship? And yesterday we were talking about these CII cost, But you go to next door to China or you park your ship next door in Indian ports,
the whole hinterland is polluted with carbon. So it just doesn't make sense at the moment.
I think at the end of the day, it's still demand and supply, because shipping industry, if you look at its nature, is a very perfectly competitive market structure. So, and that explains why C5TC last in a couple of years ago went from $20,000 to $80,000. There's basically no government regulation on how much you can go up and how much you can go down. Unlike in other commodity markets, if or stock price, stock market exchange, if you reach a certain limit, okay, you cannot do it. But in shipping, 10,000, 15,000, 20,000, as long as there is a willing buyer and willing seller based on demand and supply fundamentals, things will get done. Of course, there will be exceptionals. Some companies say that, oh, we have a policy of doing this, A, B, and C. But that's the exceptional. But I think in general terms, we still have to go back to the fundamental market structure nature of this industry, which is a perfectly competitive market, and price setting mechanism is purely done on a market basis and not by government interventionist policy. I mean, if you look at the container shipping market, it went ballistic, and the government was saying, hey, we need to do something about it. Is it oligopoly? And the next 2 years later, it went all the way down, and suddenly the government is not saying anything about it. And with regards to the new use of fuel engine, right? So basically, most of these new ships are dual fuel. So basically, they have the ability to burn the new fuel or the conventional fuel type. So at the end of the day, it still boils down to economics. Is it much more worthwhile to burn the conventional fuel or the LNG? And I think so far there's a lot of LNG dual fuel vessels, and they are still currently burning conventional fuel because LNG is still slightly doesn't make sense. So yeah, that's my side.
No, just to add on to this, I think there is a lot of pressure from investors for bigger companies such as BHP and Rio Tinto to address these issues. So they have to do it, and probably we are talking about scope 1, 2, and 3 emissions, So they have to demonstrate somewhere that they're doing, they're trying to comply. It doesn't matter whether the other side acknowledges it or not, or they don't pay up, for that additional cost which they are incurring.
Thank you very much. Thanks for the gentleman. Sorry, I have to close the session. We're already kind of behind schedule by 20 minutes. Sorry, I'm kind of basically eating up the tea break and the coffee break. Thank you, gentlemen. And then I will just now ask Mr. Riza Suaji, Indonesian Carbon Trade Association, to come up to give out the trophy. Wilson, please stay on the stage. The token of appreciation. Yeah. Thank you. Sorry, so that's end the session, and then please go ahead for a tea break or coffee break, and then please come back no later than 11:30, if that is possible. Thank you, everyone. Thanks.
Ladies and gentlemen, party people, make some noise. Are you ready? 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Let's go.
you higher. I will forever be intertwined with you. Where the sun never goes down and time has slowed down. Would it be too crazy if we decided to stay forever? Decided to stay forever, forever. Stay forever. Stay, stay, stay forever. Stay, stay, stay forever. Stay, stay, stay forever. Stay forever. Jump into the fire. I'd like to see your wild side. We should run away. Where the sun never goes down and time has slowed down. Would it be too crazy if we decided to stay forever? Decided to stay forever, forever. Stay forever. Stay, stay, stay forever. Stay, stay, stay forever. Stay, stay, stay forever. Stay forever.
Baby, all I need one more chance. Oh, baby, let me show you. I need one more chance. Oh, baby, all I need one more chance. Oh, baby, let me show you. I need one more chance. Oh. All I need. Baby, all I need one more chance. Oh, baby, let me show you. I need one more chance. Oh, baby, all I need one more chance. Oh, baby, let me show you. I need one more chance. Oh. All I need.
You gotta put your past behind you. Look, kid, bad things happen, and you can't do anything about it, right? Wrong. When the world turns its back on you, you turn your back on them.
That's not what I was taught.
Then maybe you need a new lesson. Repeat after me. Hakuna Matata. Hakuna Matata. It means no worries.
Good morning, ladies and gentlemen. We are about to start the third session of the day. I request all those gathered outside to kindly come inside the hall. The next session is about to commence in a couple of minutes. Requesting those gathered outside to kindly come in as the next session is about to commence. Yeah, do kindly walk in before the door closes. The penultimate session on carbon trading and carbon markets is about to start in a short while. Requesting those gathered outside to kindly come in, please. Yes, so we are about to start our session on what are carbon markets and why are they important. This is the penultimate session of this conference. The expert joining us for this session is Dr. Riza Suwaga, Chairman, Indonesia Carbon Trade Association. I request Dr. Suwaga to come up on stage, please. Dr. Suwaga earned his bachelor's degree from Ohio University in economics. Just a second, please. Yes. So Dr. Suwaga earned his bachelor's degree from Ohio University in economics, double majored in mechanical engineering, received special director's scholarship for master's in management from Trishakti University, and earned his PhD in resource management and anthropology from the University of Indonesia. He has written numerous articles and books on forestry. He was the vice chairman of Eastern Indonesia Economic Council, while together with the Ministry of Environment and Forestry, he formed the Eco-Label Desk. He is also a member of the Ministry's Board of Experts of Technical Committee for Environmental Friendly Technology Verification and Special Committee for Public Facility Services Standard. Welcome, Dr. Suwaga. I now request Dr. Suwaga to commence his presentation. Over to you, sir.
Distinguished speakers, ladies and gentlemen, first of all, I would like to thank the organizer for inviting me to speak today. And it's a bit challenging for me, to be honest, because I'm speaking in front of a different space of coal and steel community. But I know that we both can collaborate. We need each other, I can say. So I think we can start doing this in a much more positive exchange. And I would like also to extend happy Songkran festivities and also Eid Mubarak for those who celebrate. Today I'm going to a bit discuss about how carbon market is important, and I think it will be a bit, like I said, challenge. And more or less, I will discuss more on the Indonesian carbon market updates. What are the opportunities and concerns? Next, please. These are some of the activities of the Indonesian Carbon Trade Association. We are very active, supporting and participate in G20, B20, both last year in Indonesia and also in India. We have supported Indian G20 committees in this form of carbon market future and how it will contributes to mitigating climate change and to the world economy as a whole. Next, please. Maybe this is like carbon credit 101, I might say. How we can describe, I think the left picture will illustrate how the coal-fired power can generate and what can coal-fired power also be able to earn or eligible for carbon credits. Usually, carbon coal-fired power plant have a cap emission that will be declared, and then the remaining or the allowance that what remains that can be traded either bilaterally, B2B basis, or also you can go to the exchange. And the easiest way of doing carbon credits, I think, is what I am doing right now. Actually, I am currently developing 3 nature-based carbon projects, which is forestry and other land use. And what we can do is offering you an offset. I know that the question is very simple, I think. Would it be realistic to say to shut off a coal-fired power plant in the next 10 years or the next 20 years or the next 30 years? I will personally say it will be impossible. But also I think we need to find solution. I think yesterday's session, you guys talk about how to mitigate and to deliver a much low emission coal-fired power plant, maybe blending it with the wood pellet and that sort of thing. We can always find solution. And I think the beauty of what carbon market and what carbon credits can help you, of course, we can offer the nature-based solution, type of carbon credits that coming out of forest conservation, like the projects I'm doing right now. We will talk later about greenwashing. I heard greenwashing terminologies that is being raised even today. It's very subjective, I could say, but I think as long as all coal or steel players have the roadmap or the blueprint want to do better, I always believe that that matters. Next. I'm not going to discuss too detail about this, but I think you guys probably already knew this how you calculate scope 3 emissions. I think scope 1, scope 2 also you already pretty familiar with that. Next. Next, please. This is an example. Maybe it's a bit small, but Indonesia has applied what considered to be taxonomy, because in Indonesia, fortunately, we do have quite abundant forest resources, natural resources, and the environment friendly roadmap. Those funds can be generated and can be channeled and can be packaged together. So when we shut off, quote unquote, the more fossil fuel type of power plants or energy, we can take off with other form of much more renewable and green energy in the future. Next. These are type of carbon credit retirements by vintage from 22 to current. If you look at the type of forestry, I think you will see the more forestry and other land use vintage credits being used or being traded, and most of the buyers, I think, are we consider to be the carbon emitters, but do have a very good blueprint and roadmap to reach net zero emission. Next. Next, please. This is also a very interesting one of the Sustainable Development Goals target, that every dollar invested in forest restoration creates around $18 in economic benefits. So I think Shell, for example, is one of the advanced nature-based division within the group. They have invested tremendously in nature-based investment all over the world, including Indonesia, because they know, I think, the future of it. Even though they also have been criticized for greenwashing and that sort of thing. Next, please. Yes, this is, I think, what will be an interesting part. How I can somewhat illustrate the Indonesian potential. Currently, if you could see on the left side, there are 232 projects already registered, lining up, and it is representing around 3.5 million hectares, and it can deliver somewhere around 112 million tons per annum potential. This is only 1/3 of the total 9 million hectares that the government is allocating for carbon projects. So Indonesia alone have NDC target. NDC is the nationally determined contribution, which is the emission target that needs to be lowered by 2030, which is around 83.4 million tons per year. So then we will have like 30 million tons free to be traded. But again, there will be potential if all 9 million hectares will be implemented. Indonesia will provide somewhere around 250 million tons per year carbon credits. So I think there will be potential supply in the next 10 years from multi-sectors that can purchase or can be traded in the market. this is actually still only a partial percentage out of 120 million hectares that Indonesia have. As you know, Indonesia is the second largest tropical rainforest country in the world. Next. This is one of the projects that I am currently developing called Kuburaya Mangrove. We restore and conserve 18,000 hectares of mangrove forest in West Kalimantan. It has a very unique indigenous animals, very protected animals such as proboscis monkey and Irrawaddy dolphins. So we restore mangrove forests, and hopefully we can deliver somewhere around 42 million tons of ECU within the next 20 years. And of course, somewhere around 15,000 population will be affected that can gain the benefit, all the villages around the area. These are the type of projects that you can invest or you can buy carbon credits that coming out of this kind of projects to be offsetted as a solution, like I said in the earlier. Next. Typically, nature-based solution carbon projects can achieve somewhere around 13 out of 19 sustainable development goals that can be achieved. So this is easy target and easy achievements that can be implemented. Next. So I'm just going to go through very quickly. This is also part of the solution and also embedded and blended within the carbon projects. We like to integrate high tech or deep tech for the MRV purposes, for monitoring purposes, for calculating and also measuring and also monitoring all kinds of activities, be it climate, community, and also biodiversity all around nature-based projects. Next. This is an example of how tech matters. We can easily calculate. If you can see this is just a highlight, understanding the robust MRV that can calculate the biomass potential, how much carbon credits can be generated. Of course, the darker picture shows a more density of the forest itself as we go along from site to site. Next. Next, I think we just similar to that. Next. So these are also an example combination of satellite, lidar, and also we call it flux data. We put instruments into the areas, be it mangrove, be it peatland. We can know the exact above ground biomass, also below ground biomass, and soil organic carbon. And these are all technology related, and we put it all together in most of our projects. Next. What we can say about the same satellite technology, IoT, artificial intelligence, we call it hybrid approach. We put all together, and the aim of this approach that most of the buyers can able to monitor and to see from their handheld, hopefully in the future, that our projects are transparently can be overlooked and can be monitored. Next. I'm just going to go to next. So this is an example of our previous projects. So before we step in to one of our project in Sumatra, we just overheard and rumors about the existence of Sumatran tigers. On the left side, at first we only see the proof of footprints of the tiger itself, but after a few months, we caught by camera traps how it looks like, and now almost every day the tigers is showing up in the camera traps, and we can proudly able to say that we have able to restore and conserve the area. Next. So this is also an alternative. What we can say, Indonesia also preparing what we call the carbon exchange. So both the nature-based offsets and also allowances for that able power plants that already have a cap and they want to trade their allowances can be done through the exchange. The exchange itself will be launched in June this year, and the first auction will hopefully be executed in September this year. So I hope we can all be participated in that. I will be responsible for supplying the nature-based carbon credits to the exchange, and the exchange itself will be led by Indonesian Stock Exchange (IDX). So hopefully it will be one of the most high integrity exchange in the world. Next. This is just the product features, how the allowances on the left side, as you can see, those are the cap power plant, coal-fired power plant that already being announced by the Ministry of Energy recently, and it will be one amongst of the carbon credits that will be traded hopefully this year. And on the right side, of course, there are multiple kinds of carbon projects that can be sold within the exchange itself. Keep in mind that we can both trade it through the exchange or also directly bilaterally by means. Next. These are the basically the timeline. So hopefully everything will be done in second half of 2023 this year. Next. So what are their concern then? I think the first question is very much into you guys' interest. Is retiring coal-fired plants in 2025 a realistic one? I think our President Jokowi has announced that or made a statement in Hanover recently that Indonesia will begin start retiring coal-fired power plant by 2025. Personally, like I said, it will be difficult. It will be challenging. That's why I think carbon offsetting is one of the solution. So that's why I'm here today to speak in front of you. There are many opportunity and also concern. Of course, with international standards, also have bottlenecks everywhere, and we do needs to work very much hand in hand on that. Next. So, what are the conclusion? I'm just gonna go directly to the conclusion. So, if you just go to number 8, carbon offsetting. Maybe it's too small. I'm just gonna read it. Carbon offsetting is one alternative solution to tackle energy transition steps. Like I said, it will be very difficult or challenging to shut down permanently or completely, entirely on fossil fuel, especially coal. But also we need to work together and to find the best solution. So Indonesian forestry and other land use is more than ready. So this is one of the solution. Greenwashing, again, is an issue that needs to be handled properly and to be solved objectively. So I think these are the key issues. Next. Well, that's all what I can present to you guys today. Thank you for listening. And yes, we have also an event in November called Digital Carbon Expo. It will be supposedly we will be in Bali. So hopefully all of you could come and participate, and we will announce and share in more detail. Thank you very much, and God bless you.
Thank you, Dr. Swaga. Requesting you to take your seat, please. So, before commencing the formal question answer session, I would like to take questions from the audience. So, if there are anybody in the audience wants to or has questions for Dr. Swaga? Okay, then let me ask a few. Actually, we were talking about the voluntary carbon market also, plus the cap and trade market also. So, wanted to know from you, as an expert, the relative advantages and disadvantages of the two systems, sir.
Thank you for it's a very good question. Well, most of the cap and trade deliver or can be executed in the mandatory market mostly. So I think for mandatory or compulsory market, usually they are more regulated. Hosting countries or a related government usually require players to do it. So they do announce or require certain cap for certain coal-fired power plant, for example. Then they have to abide and to follow that cap. So, but usually that cap is below what can be actually can be resulted from that coal-fired plant. So the remaining of we call it the allowance, those can be traded. But most of them contributes to host countries' NDC, the nationally determined contribution. On the other hand, for voluntary carbon market, it's more relaxed, more free, because it is funded, invested, traded, all by private sectors, not so much regulated, even though some countries, like Indonesia, start to regulate the voluntary carbon market as well. So Indonesia is, we call it, is more like a jurisdiction voluntary carbon market. But for the buyers, I think Indonesia can consider to be a much more high integrity ones because the government is fully supported, both.
Yes. So before going to specifically to Indonesia and Indonesia's experience and evolution of the carbon markets in Indonesia, so give us a rough picture of how this evolution took place and for how long has it been going on, and what kind of a stage of development it has attained as far as Indonesia is concerned.
Carbon market itself, like most of the three first carbon projects, which is Rimba Raya Conservation, started 10 years ago. Rimba Makmur Utama also around that period. My previous project, Sumatra Merang Peatland project, started in 2016. trading in 2019. We sold our credits to multinational companies from Europe, such as Chanel, L'Oreal, Heathrow Airport, Microsoft, etc. So now we have also recently our government released presidential decree on carbon economic value and also ministerial decree with the same purpose recently last year. So I think looking at the future, Indonesia will be spending more and more concentration on how to not just quote unquote regulate carbon market, but also making sure that Indonesian carbon credits is fully trusted and can deliver high integrity products.
Yeah, so from Indonesia, if we move on to a more general understanding of carbon markets, there have been apprehensions that have been voiced about the effectiveness of carbon markets when it comes to curbing emissions, as the entities may continue to purchase carbon credits than to invest in clean technologies. So, how can policymakers address this particular dilemma?
Yeah, I think carbon credits itself, to a lot of people, still considered to be a challenge commodities. We've seen that carbon credits is, I can say, an intangible commodities. You can't see it. Only certified ones are able to be traded. That's why the government is putting a lot of efforts. They want to make sure Indonesian carbon credits are really genuine, really have an integrity. Even the carbon exchange itself is being managed and led by the Indonesian Stock Exchange. As you have known, that Indonesian Stock Exchange is one of the largest stock exchange in the region, have a very strong reputation. For Indonesian Stock Exchange itself, to be honest, they currently traded about, their turnover is about $1 billion per day. While if they're doing carbon exchange, I think most of the carbon exchange in the world, in yearly basis, they only traded around $3 billion per year. So it's way too small for Indonesian stock exchange to run such a carbon exchange. But since they feel that it's important for the future, so they do it anyway. So if you just look at the whole ecosystem, how Indonesian both government and private sectors hand in hand together and to bring and deliver such a good and high integrity carbon credits, I think you have seen the preparation and how I can add to that that 3 of the first Indonesian carbon projects I mentioned earlier, they all are the recipient of the highest awardees of Vera, which is now the most preferred standard by the international market.
Yes, so we have a rough idea of Indonesia's decarbonization targets. The government has also has a target, of course, and has a timeline to achieve that target. So, how relevant do you think that carbon trading? How effective will it be in achieving the target? So, for in the specific case of Indonesia.
I think I showed you the picture about the Indonesian potential. As of now, for example, just taking out of one sector only, the nature-based solution, we already locked in around 230 projects, for example, that can deliver about 112 million tons of carbon credits per year. While our target to meet the goal of achieving national determined contribution, which is lowering our emission by 2030, is only 83.4 million tons per year. So we are already exceeding the target.
So with the base year being, I mean, like 2030, what is the target of reducing emissions overall till 2030? With the base year being what?
Yeah, the target is 2.8 billion. Well, our emission is 2.8 billion tons. So our goal that has been committed into the UNFCCC Paris Agreement is 29%, which is 834 million tons by 2030. Like I said, if you divide by 10, it's 83.4 million. And the 230 projects is only 1/3 of the 9 million hectares that already being allocated. So if you accounted for 9 million hectares, then we will talk about some 3 times as much as the available carbon credits that can be generated, can be supplied by Indonesia. This only for one sector. And Indonesia have also other sectors that is being targeted, such as energy, industry, waste management, agriculture, and so on. And yes, 70% of our target and also achievements are coming from forestry, because like I said, Indonesia have abundance of nature-based and forestry and other land use potential.
Yes. So actually now moving on from Indonesia to the world stage, we know that the European Union has been the trendsetter when it comes to the carbon market and carbon pricing and all that. So as far as the pricing is concerned, sir, we see that in the EU it is around $90 to $100, not even $100, around $90. So, but the prices in other parts of the world are very low. So there is this disparity. When do you see this disparity slowly? I mean, like prices going up, say in China, say in other parts of Asia. So when do you see those prices going up? And so what is the timeline? I mean, like 2030 or 2040?
Basically, you're talking about the ETS, European ETS, already gone up to $90 to $100 per ton. Those are, we call it the mandatory ETS, right? So when you talk about the lower side, which is now around $10 per ton, which is coming from the voluntary carbon market. So since voluntary carbon markets are the other alternative solution that is being created by the private sectors. So like I said, they are creating their own ecosystem, but this ecosystem is slowly but surely gaining much respect and more respect from all the buyers and globally. So I think we have seen a tremendous increase in pricing. When I started my projects, even back then it's only $2 per ton. Now already $10. Some auction for mangrove already reached up to $35 per ton. I think one of the mangrove project in Pakistan reached somewhere around $37, but average around $28 per ton. Recently, just doing the auction by the CIX in Singapore. So I think a lot of forecast has been indicating that the price will catch up of course, they talk about between 10 to 20 years to catch up, but some prediction will predict that it will be sooner than that.
Okay. So one question on China, sir. Actually, um, China we know has this carbon market, carbon pricing, but only the power sector is part of the ETS in China. The other sectors are still out, like the chemicals, the pharmaceutical sector, or the iron and steel sector. So how do you see, China's evolution going forward?
China always have a very interesting way of doing it. I think because they have their own market, they are very big, so they do have their own standard. They do have their own exchange. They do have their own registry. Going forward, I think China also will perform similar to other markets. Of course, they're more concentrating on their own right now. They're not buying from overseas or selling to other countries because I think the government also is requiring to have their offsets within the countries themselves. But what I heard and the forecast has predicted that I think China will also open up to the global market and will both buying or selling to overseas.
One question also on this, which is bothering regulators the world over, I think, is about carbon leakage, like re-establishment of industries in countries with not so tough carbon jurisdictions by countries who want to, kind of offshore, like send their pollutions to overseas. So, how to stop this, and what is the effective way of dealing with this problem?
It's a very always a very tough questions to answer. Leakage will be associated with challenges and also and even many times people will say this is related to greenwashing. But personally, again, I always like to see the intention of every industry. And nowadays, I don't think industry will able to perform in the future without having a very good a blueprint or roadmap of having a much more sustainable roadmap. And otherwise, their funders will not be giving the money. So I think so much, if you can say it's a pressure, but I think I will treat that as a good intention of having that. So in terms of leakage, there are of course a lot of criteria and we always tend to fulfill that scientifically. So as long as the methodology are met and there are good intention of trying to save the planet, I will say the leakage itself is can be measured scientifically.
Yes, so this is a very interesting point that you made, sir, that the leakage could be measured, because one thing that directly comes to mind is China, and China moving investments to Indonesia, particularly investments that are carbon intensive. For example, metallurgical coke making, which readily comes to mind. So we should be. Don't you think that Indonesia should be in a position to measure and quantify these emissions, and there should be I mean, regulation to address this problem as well?
Yes, I think that part is being thought and being calculated and being measured. I believe there will be some regulations that will require that approach.
Yes. We have been talking about this scope 1, scope 2, scope 3 emissions. Um, Indonesia, of course, has its own net zero target, its own decarbonization pathway. But when it comes to, for example, coal exports, so how to address this problem? Now, a country which is targeting about 516 million tons of coal exports in 2023 to different parts of Asia, even Europe now, although volumes are small. But so, how big a challenge this is for Indonesian regulators?
Well, I spoke about this similar question. I think 2 weeks just before Ramadan, I was invited by the Indonesian IPP Association, the Independent Power Producer. So I said, honestly, I kind of said it. Just I told the audience that don't count me as a provoking you guys. I said because looking at the potential that we have from nature base, I think we have plenty of carbon credits that we can sell, we can trade, we can offset. So I think I'm not recommending the government to enjoy what the coal price that they're receiving right now and get a tax out of it. But I think, honestly speaking, after COVID, after Ukraine war, I think globally the landscape is changing. So if you have a chance to gain something out of that, why not? That's what I said. So, but of course, if I speak about this statement, I might be getting pressured or criticized. But I think we have to be very realistic. While we have a very good potential of nature-based carbon credits, on the other side, of course, we cannot shut down coal players or miners or coal-fired power plants. I think they have been suffering in the previous years, even before COVID. Coal price was very terrible. I heard a lot of concern that coming out of from my colleagues that are coal players. If they want to enjoy the profit what they're making right now, let it be. That's what I said. So of course it's not going to be forever. We need to have a roadmap of having a very good, a responsible manner. If we have to do a much more responsible managing the coal mining and for the whole value chain until the scope 3 and delivering it, I think we have to do it anyway.
Yeah, thank you, Dr. Swaga. That was a very fruitful discussion that we had on carbon markets in general, as well as on Indonesia's efforts in regulating the carbon market. Thank you so much for your insights, sir. That was a very interesting session that we had. To felicitate Dr. Swaga, I would now like to call upon stage Mr. Mahroof Mohsin, Executive Director, Rahim Group, Bangladesh. Mr. Mohsin. Round of applause, please. Thank you, Dr. Swaga. So after this enlightening session on carbon markets and carbon pricing, we come now to the very last session of this conference on day 2, which is on disruptive mining technologies and decarbonization in mining, and a very interesting topic. The expert joining us for this session is Mr. Prabharan Gopalan, Expert Associate Partner, McKinsey & Company. I request Mr. Gopalan to come up on stage, please. Mr. Prabha Gopalan is an expert associate partner with McKinsey and Company. He leads technology and data-enabled transformation in mining and heavy industries. He advises senior leaders on improving productivity, efficiency, and reducing carbon footprint across the mining value chain, which includes operations, downstream processing, maintenance, and procurement, as well as effectively leveraging artificial intelligence, cloud ERP, and digital tools. He leads McKinsey Digital in Indonesia, and he is based out of the Jakarta office. Welcome, Mr. Gopalan. I now request you to commence your presentation, sir.
Hi, good afternoon, everyone. I realize I am the last man standing between you and your flights back home. And after a day and a half of intensive sessions, we'll talk about what's happening on the technology side. Overall, we heard a lot about the market trends, the demand, the supply, the pressures in the supply chain, how companies can stay afloat and competitive, keep the bottom line up, and what's going to happen in the future, right? So let me give you a perspective of how we, from the consulting side, see things happening overall, right? Number one, all these pressures are real. Yeah, we see, just for context, I advise coal mining companies in Indonesia, South Africa, and Australia. Plus, I also advise companies on other commodities as well across the mining value chain, right? The focus on productivity and safety has never been bigger, especially during COVID, post-COVID, especially when the price was volatile. Last year was an exception. Last year, people threw cost, capex, all that out of the window just to produce more to capitalize on the price rise. But now, as the prices are cooling down, companies are now looking at how can I actually get more bottom line with the current price outlook, because I now have to commit more cost to keep up the production that I have to maintain, right? That's number one. Number two, what we heard is, in terms of sustainability and the focus on decarbonization, and with the developed economies switching to non-coal alternatives, and even developing economies setting a target on, diversifying out of coal for their power plants, right? And that has an impact on how companies think about slightly longer term. It's not the immediate year, but the next 3 years, 5 years, 10 years from now, what's going to happen to their coal mines, for example, right? And couple that with what is happening on the technology side, which is the focus of my topic, right? In the past, you have heard digital transformation a lot. That was the last 10 years. And you would see news about AI with ChatGPT and everything disrupting how we do even everyday jobs, even making a presentation, even asking Google for things. People are now going to ChatGPT, right? And there are more technology disruptions that are happening on the horizon or brewing that's going to take over the industry by a storm in the next 5 to 10 years. Now, there are concerns around, do I prepare for it? How much should I prepare for it? And should I start parking up capital and invest in proof of concepts, invest in research on some of those technologies, while I am fighting to keep my bottom line up because of my cost pressures are going up? There is a whole bunch of things that are happening on the technology which we'll talk about. And then, all of this is also, if I'm taking the lens of a CEO of a coal mining company, be it a contract miner, be it a mine owner, the day to day, these are challenges. Day to day, they are worried about all of these things happening. However, every once in a while, they do take a step back and they see what's going to happen to my mine 5 years from now. Will I grow? What does growth mean even in that context? How do I strategize? Right? That's where we come in on strategy consulting side on, how can I set up my company right now? What are the things that I need to put in place for me to deal with growth as it would happen in the future? And some of these things I'm not putting on page. I'm going to verbalize it because as consultants, we are not supposed to share a lot of things printed media. Big companies are already diversifying out of coal. Right? Either they are committed publicly, like one Indonesian conglomerate said, they are going to move 50% of their core revenue out of coal, right, in the next few years. And some of those, globally big names are already finding alternatives. Some of them moving to other commodities. Some of them are thinking about growth beyond coal, right? So that's happening as well. That's the biggest strategic level of, dealing with this impact of coal demand, coal price fluctuation, and the focus on sustainability for those big companies. So that's at that level. Then there is, okay, if that is what I'm going to do 10 years from now, right? I'm going to diversify out of this commodity. Between now and the next 10 years, how can I actually get the most out of the mines that I got going right now, right? What are the things that will give me the edge over competition to, fight with this price wars? And a whole bunch of things that has happened in the last 15, 20 years. And when I see technology, I've been doing this for the last 7 years in Indonesia, right? And in the technology field for about 15 years. What we thought were disruptive technologies are now table stakes for most of these big companies. If you think about IoT, some of the big companies that I serve have more than 100 sensors in every single one of their trucks sending data every single second. The data goes into the GBs and the TBs by the day and by the week, and they are actually analyzing every single bit of it to help them improve productivity, improve efficiency, reduce their cost, any which way possible, right? So IoT, you'd see a spectrum of maturity in companies, some of them heavily sensorized, some of them zero sensors, right? And it would varies from developed countries to developing countries. Even in the developing countries like Indonesia, you would see some clients who are more mature, some are less mature. But the ones who are actually surviving all of this comfortably have gotten a lot more technology maturity on their side. Number two, cloud was a big topic 5 years ago, and some companies have completely missed the bus. They are not yet on cloud because they said technology is not a big problem for us just yet. They have other problems. But other companies have leveraged cloud effectively to further their innovative agenda in terms of, can I get maximum out of my analytics? Can I get maximum out of my data? And how can I do this without committing significant capex on hardware on the computer side, for example, right? So that's becoming, it's not as tough a conversation as before. And network infrastructure, some companies in India had this challenge, Indonesia had this challenge, and there are innovative ways that you can deploy network to overcome these challenges now. And more companies are actually coming up with ideas like a low-range wireless network, 5G. It was 4G before, 5G is on the horizon. Some companies are trying with it. Satellite network becomes cheaper. So then network infrastructure is no longer a huge problem, right? So these are all now enablers for companies to leverage tech to get more out of their operational minds right now. And the last 5 years saw a huge amount of adoption on digital. Digital is purely about moving from paper-based or Excel-based to software-driven, data-driven decision-making across the different parts of the value chain. Have a picture which shows like more than 80 to 90 different digital use cases possible across the mining value chain. And like 40 of them I have personally done in my own experience, in my own clients, and the others globally, as McKinsey, we have done it. That, you'd see majority of the companies will now claim that they have done the digital transformation. Yeah, whether they have done it truly or not is a different question, but majority will have some form of digital transformation either done or undergoing for the last 5 years. And that's why they see the value, they see how it helps them over and above lean efficiency practices. So that's done for. AI is emerging. In some areas it is proven. When we say AI, what do we mean, right? We learn from the data, we get some insights, and we make decisions based on those insights. A couple of quick examples. One is, we now have sensor data from your dump trucks coming from the 4 different wheels individually measured. And there is a formula which you can apply to see how the road is, uneven. And that unevenness is causing a lot of fuel consumption. If you notice, 40% of an OPEX of a mine company in this part of the world is fuel. And at $1 plus a liter, a $1 billion revenue company spends like close to $400-500 million on fuel. A 5% saving is huge to the bottom line impact every year, and that's rolling, right? And we have seen this particular solution helping deliver anywhere between 5 to 15% of fuel consumption savings just by using the data that you got, right? Now, things like that are actually helping them improve their bottom line and helping them improve their productivity, because some of these use cases help them reduce capex on new equipment in the future. Like, I have to produce 50 million tons of coal next year. How much fleet do I need? Then some of these technologies will allow them to say, oh, you actually need 10% fewer fleet. So it frees up capital, right? And it frees up more cash flow for you on a year-on-year basis. Now, why does this matter? How is this helping, right? Now, people are using some of this freed up capital to actually deploy that capital into ways that they can mitigate the risks of this pressures that they are facing on the sustainability side, on the price difference side. Now, how does that work? Some of these companies are actually using this capital to retrofit some of their fleet into electrical units. Because, as you know, coal companies are finding it hard to generate funds from financial institutions if they are seen as dirty, right? One way to actually get a quick win of their carbon footprint is to electrify their fleet. And the easiest way to do it is some of their light vehicles like cars and whatnot, right? And there are companies who are actually experimenting electrification of their small equipment mobile fleet. The electrification of large equipment is happening elsewhere, not yet in developing countries, because it's going to be a bit tricky given the mine conditions. Mine plan has to change and it's a lot of capex. So companies in developing countries are not yet seeing that as a primary thing to do. However, this capital allows them to do some of these activities, which is preparing them for the future. One of my clients actually deployed this capital to build alternative businesses, right? So we are supporting them build new businesses just by freeing up some cash flow, right? These are things that is happening on how technology helps beyond the immediate cash cost reduction and also helping in sustainability, right? Now, what are we watching out for as what could be in the future, right? Autonomous fleets have been in discussions for quite a while now. However, countries like India, Indonesia, South Africa, for example, are not yet ready to experiment even, because some of those autonomous trucks need a change in their mine plan. In open cast mines, that's a capex intensive operation, and companies are not yet ready to do that. However, in some Australian mines, like the rail lines are autonomous already. In South Africa, some of them are autonomous already. Australia is experimenting with haul truck automation, where you don't need an operator because labor is costly there. When the conditions are right, companies are moving towards that. And we already have seen autonomous operations in some use cases like drill and blast, where you don't actually deploy as many humans to get things done, right? So we see that as happening. When the conditions are right, for developing countries, it could be a few years into the future. We would see this, driving down the cost, improving efficiency of the companies, right? That's number one. Blockchain had some use cases, was really peaking like 3-4 years ago, but now the talk of it has died down. Metaverse, not yet in mining, but blockchain as a technology was used in some cases for provenance tracking. Some of the companies are using it for carbon tracking. Earlier we talked about how do you ensure accuracy of your carbon emissions, right? As a mining company in the operations. Then one way to put that is put it on a blockchain where everybody can verify, right? So there are some use cases there, but not at mainstream adoption. We don't see that as being super disruptive in the way mining companies are run. We talked about AR, VR at some point. There is a whole wave of digital twins and all that being discussed, right? It has some use cases, but not yet to be disruptive of the industry itself. The biggest disruption that we see potentially happening is with electrification and autonomous fleets. Electrification will actually push a lot of companies to rethink how they deploy capital to their assets, because majority of these companies are in ICE vehicles, internal combustion engine vehicles, and it's on their books, which means when they have to move to electric vehicles, they only got two choices. Option one is retrofit, change their existing equipment with all the body and everything to an electrical unit, or buy new electrical fleet. And new electrical fleet is super capex intensive, and it is not yet proven for big haul trucks that are deployed to coal mining companies yet. Hence, in the next 5 to 7 years, we see that being super disruptive, right? When it happens, it will coincide along the timeline where the demand for coal goes down and the price goes down further, as projected, as we discussed, throughout these days, right? Then the question is, there will be a pinching point for mining companies to decide on how they survive that disruption when they're already pinched for cash. So those are the things that we see on the broad horizons, and some of these in the next 3 to 5 years, we see still potential for digital and analytics and big data, uh, because in our experience, it has potential to deliver somewhere around up to 25% of yield, energy, throughput, quality improvements across the value chain. And as you see, you know, advanced analytics gives you a lot more on your processing and extraction side, because most companies are pretty much mature in terms of their lean operation practices. How they do equipment allocation, how they do staff allocation, how they do the handover processes from the shift to shift. All of this, they got most of it. However, in terms of how effectively they can leverage technology, there is still a long way to go. And if companies don't do this in the next 5 years, when the next wave hits in terms of further sustainability pressure, further cost pressure, and price going down, it will be even difficult for companies to withstand that storm unless they reduce their output to a level where it makes sense for them, right? And just as an illustration, right? So we have seen technology, digital tooling helping across the value chain. We have seen startups now doing a lot more analytics-driven exploration even. One of the things that we didn't talk about as far as today concerned is, are there new explorations happening in coal, right, or other commodities? There are companies who are now using satellite imagery, drone-based imagery to understand the ore body quality that allows you to reduce your exploration cost. So we just heard that coal is probably not going to disappear anytime soon. It'll be in less favorable, but not completely disappearing, because Indonesia, one of the power companies, have set the target of non-coal based renewable based energy creation. The target is 2050 or 2060. Until then, there will be some demand for coal, right? And the question is, how can you be more effective and efficient in getting that coal out while giving you enough of cash flow to deal with the fluctuation that's going to happen in the supply chain, right? Similar with analytics. This wasn't the case 2 years ago, but now we are seeing more and more AI-based use cases across the value chain, and some of these are super complex to the level that you can solve for multiple variables. For example, can I reduce my fuel consumption, improve my production while keeping my profitability to the maximum on a day-to-day basis? Data can answer that question now. And that is incredibly powerful if you are looking at it from a CEO's perspective on a quarter-by-quarter bottom line numbers. This is going to deliver a lot more value than all the previous initiatives combined. And we are seeing there's, for example, in coal blending, one of my clients has more than 20 different products that they're selling of coal, of calorific value, sulfur, ash combination. And just by optimizing their blending, we are thinking of bottom line impacts to the tune of $5 to $10 million, pretty much every quarter as impact, right? And it goes up as they narrow down their product portfolio. But if you think about how technology impacts coal mining company strategy, this is one of the cases where we are able to prove that your product portfolio needs to be streamlined, and here is the dollar impact that you will get by the end of this year if you do that. So technology is now shaping up the way they think about product strategy. They think about pricing strategy. We are now helping them go through their legal contracts with AI and find wordings that will help them negotiate better according to the text in the contract that they have. So this is giving them an edge, right? So we see some of these around generative AI technologies deployed to these good users to say, how can you be profitable while you deal with all this macroeconomic geopolitical shifts that are happening? And more and more, we see companies are now looking to technology to say, these are my big problems, but help me be profitable on the stuff that I'm producing now, and free up my cash flow so that I can deal with some of these bigger things, right? And not only that, we also see a lot of these technologies also helping you to reduce your scope 1 emissions. Because For a coal mining company, the biggest problem is scope 3, because it's used for power generation, and that also counts as your impact, right? But if, as I said, 40% of your operational cost is fuel, you're burning like millions of liters of fuel. Some of these technologies will help reduce that scope 1 footprint itself. And we are also seeing scope 2 impact as well, and some amount of scope 3, to say, can I analyze your procurement data and give you recommendations on which of those companies are more greener compared to your current suppliers? And that is allowing them to change the supplier portfolio to say, let me now move to more greener options to procure, right? This applies for large companies, medium companies, not as much. But if you're like a huge corporation, then this has a significant impact on your emissions, right? And we have actually seen, overall, across the value chain, technology has the potential to reduce your scope 1 emissions significantly. Even if you think about like a global scope 1 emissions of greenhouse gases for all the industries together, this one will help you reduce like 0.01 gigatons. It's not even like megatons, right? Gigatons of emissions deploying technology. And one of my clients in Indonesia actually used this as a way to get access to better funds. Because if there are 3 companies competing for capital access, and the private equity or whoever the institution is, has the money, and they have to choose, they are always going to choose the one which is a lot more greener, that can prove that they are a lot more greener. So then these are not just, reduce cost now, not just reduce emissions now. This could potentially mean the difference between getting a lifeline supply of funds or not getting the funds. And this could mean that optimizing your product strategy based on AI, for example, as opposed to running your current product portfolio and running a net loss in the near future. So, that's kind of how we see it. Some case studies, some examples to prove the point. But ultimately, the question is, it's not an if question, it's a when question. And big companies are already at the top of the curve to say how they adopt technology, how they leverage data, and all of that. Oftentimes, one of the things that we hear is this is an IT problem to deploy technology across different parts of the value chain. And we realized more and more it's a strategy problem, because what the data tells you, the CEO makes decisions based on that data. The COO makes decisions based on the data. This helps in contract negotiations, commercial negotiations, product portfolio strategy, and all of that. However, it's not going to, replace thinking, as people always think about AI is going to take our jobs. It's not going to do that, at least in the context of mining. They're going to complement the decision making on a day-to-day basis. And the key part that mining companies are struggling is to get talent to build and sustain these things on the technology front. However, that's becoming less of a concern, because the availability of digital talent across different geographies is overall improving, and the technology companies are actually doing their best to build the talent up. So it is a matter of perception and how the companies see it, as much as it's a matter of the talent wanting to join these companies. However, it's still going to be a challenge in terms of how to effectively leverage this technology and sustain the value. And the last point is important, because one of the things that we see is, I'm going to take an example, right? I'm serving a client right now in Indonesia, one of the largest gold mining companies in probably in Asia. Their operating model has not changed in the last 30 years. Their operating model has not changed. Sure, they got new practices. Sure, they got technology deployed in these practices. We advised them like 5 years ago to actually deploy the state-of-the-art AI tools possible, IoT technology possible, and they got that. Like, I was talking to the CEO 4 weeks ago, and like, hey, you deployed this multi-million system in place. Did you see any benefit? And he goes, oh no, I don't know what's happening with that, right? And I'm like, what do you mean? Like, I don't know, this department has got it, and they're not sharing data with the other department. Whenever I talk to these guys, they are saying that we don't have access to the data. And I'm like, you spent $6 million to build a system, deploy a system, which took a year to deploy and get right, And you're sitting on this pile of data, which is running in the terabytes of data accumulated over 2 years, and you are not getting a single penny out of it because your departments are not talking to each other. And that you cannot fix by technology. And I could guarantee you, of the 25 clients I have visited in the last 18 months, almost 24 of them have this problem. And when you go and talk about, hey, we can make better decisions, it means you need to actually change the way you talk to people, change the way your incentives are aligned. Now, after this conversation, the one thing that significantly changed is the CEO came and announced that all of this department managers' bonuses are linked to impact delivered through technology, and they have to prove it. Otherwise, they aren't getting their bonuses. Then things changed. Things rapidly changed. Collaboration started happening, process started changing. Now there are more meetings happening and decisions getting made. And I'm sure at some point in the future they will see the bottom line impact. However, it took them like 2 years to even realize that they are not getting the money's worth. So the how is equally even more important, as we have come to see. So yeah, so in summary, we do see, some technologies are proven. In the case of digital, more companies have gotten it. Some technologies are proven, but not, more companies have gotten it. In the case of AI, some are emerging, which will be disruptive in the 3 to 5 year horizon, 2028 to 2030. If I were to put my number on it, will be even more disruptive in the way companies think about mining operations altogether. As we think about, macroeconomic, geopolitical, supply chain pressures, and all of that, this will be their day to day, and those will happen, once in a while. Will be disruptive. But if this is not being watched out for, even when the situations are conducive, they will not be able to make the most of it. And that's where we see technology being a big player in terms of how you can, as a mining company, think about it both strategically and also in terms of dealing with these pressures. Thank you.
Thank you, Mr. Gopalan. I request you to take your seat, please. Any questions from anybody in the audience for Mr. Gopalan? Yes, sir.
Very nice presentation, and it gives a different perspective about the technology aspect of the mining industry. From your experience in Indonesia, I mean, at least I have seen autonomous vehicles being used in South Africa quite a bit by large miners, but I have not seen much in Indonesia side of it. So, do you see any deployments happening in that side of the mining?
Not for the next few years, if I'm being honest. I've personally seen a couple of my clients wanted to explore that. The two big challenges were, one, the autonomous trucks either need a trolley assist or they would need a very robust mine plan in terms of roads and intersections and all of that. And since some of these open cast mines in Indonesia are too deep because they are too old, like 30, 40 years old, or too new that they're still exploring, changing the mine plan to make way for autonomous trucks is a capital intensive measure. And more importantly, the business case does not add up for Indonesia just yet. Because in Australia, for example, they have a shortage of talent. And that forces them to actually think about, how can I reduce my dependency on manual labor in a way that makes sense for me? Number two, for them, the area is huge. For example, some of these are train-based systems, and which is easier to automate. Even in South Africa, autonomous systems are train-based. Indonesia, some of these mines are not yet that big for them to have a longer route to say, I can deploy an autonomous truck for, let's say 100 kilometers or so, right? Their haul distances are 5 kilometers at best, and that allows them to operate more effectively from a fuel point of view. So for me, the tipping point will happen, one of three things happen. One, electrification becomes more prevalent. Then they would have to get into this trolley model to keep the electricity happening, right? Otherwise, your trucks will have to stop for a long time. Number two, uh, labor becomes prohibitive, which less likely to happen for Indonesia at least. And number three, the technology becomes so cost economical, or everything else around it becomes so expensive that this is one of the ways to reduce the cost. Then people will start looking at it. Otherwise, the inertia to change is too high. Mine plan, I already locked up my capex in my existing equipment. What am I going to do with this? They still have 10 years left on the life. All right, labor is cheap for me. I can deploy more humans, run more shifts, and get them still maximum out of my equipment. Then at least for the next 3 to 5 years, don't see this being a mainstream adoption in Indonesia.
So I think this is probably, I mean, when it comes to cost, Indonesia probably enjoyed the best of the prices in the last 12 months, 18 months or so. So I think this was probably the opportune time to look at those kind of possibilities, right? When you have enough margins in the business to be able to spend on efficiencies. I think one is, of course, the cost of labor. Second is about the efficiencies, right? So what I've seen in South Africa, it's not just about the hauling distance. It's just that when the same truck goes, the number of trips it can make is much higher as compared to a human being making it because of the terrain, and most of the open pits have the same terrain challenge. So I think it's more about getting them exposed to such usage elsewhere is what I think is required, because sometimes we think we have a cheaper manpower, but when we actually use the truck, it's cheaper than using the manpower itself. So it's more about that. Thanks.
Yes, so the rate of adoption has been slow in Indonesia, in India. If we contrast that with, for example, Western Australia, maybe. So because the haul distances also there are very long. For example, the railway, autonomous railways, they're 370, 400 kilometers, they reach the port. But here in Indonesia, that may not be the geography. The geography may be different, and so the realities may be different. So these actually dictate the state of adoption of technology, or is it the case that the technology will have to be adopted someday or the other, only it's a question of time?
For some of the technologies, it's a question of time, but for others, it may be dependent on geographical conditions also. For example, electrification, we feel it's a question of time. There is no way that you can continue to run on internal combustion engines for long periods, because by our projections, by 2028, 2029, fully electric vehicles will be on total cost ownership parity with an internal combustion engine vehicle. Then the business case is there. And we also see companies now started hedging their investments on equipment already, because they're looking at, oh, half of my fleet is going to age out by that time. I'm not going to replace them because I'm going to wait to see where electrification comes through, right? Then it's a matter of when, not an if. However, some things like, we talked about autonomous, right? It comes down to individual mine owners and where they are in maturity of operational efficiency, because some of them still have ways to go in their lean operation practices, are still suboptimal. Hence, they are still trying to squeeze more efficiency out of their operational practices, deploy tech, which is low-hanging fruits, compared to take something as big as, say, mine plan changes to support autonomous vehicles running, because the cost-benefit analysis for that is still not yet as clear as compared to electric vehicle adoption. So that's what we see. But we do expect one or two companies in Indonesia, for example, will be the front runners of adoption that may change how others feel it. However, it won't be 80% of mining companies in Indonesia start looking at autonomous vehicles in the next 5 years. That I don't see is likely happening.
Yes, but it brings us to decarbonization mining, which is one of the aspects of our discussion today. So now we're talking about exploration, drone technology, haul trucks and electrification,
automation, and also for the logistics part, the fuel and all that. So, but as you rightly pointed out, the mining operations, their level of emissions are quite low. For example, coal. I mean, like coal mining emissions levels are quite low, but the usage of coal emission levels are pretty high. So here, I mean, for an industry which is getting starved of funds, for example, financing, there is a lot of pressure to decarbonize along the value chain. Do you think that the data analytics technologies, I mean, kinds of disruptive technologies, the adoption, there will be great interest in adoption of technologies already for an industry which is viewed as a kind of a sunset industry?
I think going back to the previous conversation on carbon markets, right? Coal will continue to be there for the foreseeable future. It's not going to disappear overnight. However, the pressures to be greener will become more prevalent, because even I think last week we saw European Union announce that they are not going to import products which are result of deforestation happening after 2020. So if you are exploring new areas and you have to clear out forests, you will likely get impacted by such a regulation, right? Now there will be three parts to this conversation, right? Part one is who are the net importers of coal and in terms of industry, and are they becoming greener? That is beyond the coal mining companies' control, and there are pressures for them as well. Like steel making is now looking at how can we become greener, right? And we're also looking at ammonia, for example. Other commodities are now looking to become blue and green in terms of for their own sake, and that will have an impact on coal. Your own scope 3 will likely go down if your downstream industries are becoming greener, right? So that's part one of the conversation. Part two is how much is the demand going to go down, all right? And that will have a role to play in terms of, do you really need technology to reduce your scope 1 and scope 2 when majority of emissions is scope 3, and those will continue to be there. Like Indonesia, power plants are now using biomass, co-fired plants, for example, right? Renewable is still out there in the horizon, but not as prevalent. Then if your net demand goes down, the point of break even for technology investments to reduce your carbon footprint might become less viable. And hence, they may not look to fringe technologies to reduce a bit of scope 1 here, a bit of scope 2 here. They may go for broader initiatives like electrification. Like if you change all of your fleet, then that's like 30-40% of majority of your emissions in your control, right? Then the only thing that you can not control is downstream, which is anybody's guess. So in terms of investments in technology, we do see will happen. However, whether the scale of investments, will it be, let's say, 10% of my EBITDA in 5 years or so? Hard to say. Probably yes, if the regulation becomes stricter, if the downstreams become cleaner, then your emissions are the only thing that you can control, then companies will take it a lot more seriously. However, the timeline is a bit fuzzy for that, for us to have a clear view on that.
Yeah, the timeline is still fuzzy. I just wanted an idea as a layperson that we are talking about, exploration, mining activities and everything, technologies associated with those. What about, after the life of mine ends? So for reclamation and rehabilitation, I mean, what kind of technologies, are there that companies can adopt?
It's an interesting question, because even if some of my clients, their mine life is still further out, but they have to reclaim the areas that they have mined in the last 5 years, 10 years, because that particular pit has now done for. They have to reclaim it, and that's a 15-year process for them in terms of regulatory demands to be met. The companies that are doing that are now looking at drone-based surveillance to see, is my green cover correct, is my refill ratio correct, and all of that. Some of the companies are looking at technologies to say, am I looking at my water management correctly for the reclaimed areas, in terms of volume of water required to reclaim, how can I be efficient on all of that. However, that's one part where we haven't seen significant innovations happen to say, how can you reclaim faster or reclaim better beyond monitoring to say that you're reclaiming according to what is needed. Because if I'm being honest, companies are looking at it from two lenses. One is it's a regulatory requirement. I will do the bare minimum I can, all right? And to that extent, I need to ensure that I comply with the regulations, right? The second lens is, as I'm doing it, I want to be as cost effective as possible. Now, both of these, at least in Indonesia, they are deploying more manual labor to do it. And some companies are using drone-based surveillance to say, is my green cover accurate? Is my plants growing correctly? And all of that. But no significant innovations has happened on that side yet. Probably something will happen on the ag tech side of it, but less on the mining side of it. But I haven't seen widespread deployment or even in the proof of concept stage in Indonesian companies yet.
Yes. In fact, reclamation and rehabilitation is a major thing for companies. So we one other thing that I was thinking about was this automation. In mine, we talk about when drilling, blasting, mining process and everything, but we miners are also dealing with equipment and huge equipment at that. So what is the scope of predictive analysis and maintenance of those equipments? So if you could just kindly throw some light on that.
So that's one of the biggest areas where value can come from, especially when you're thinking about increasing your equipment availability and uptime. We had gone from 4 levels of maturity in terms of maintenance, leveraging technology. The first one is just digitizing your maintenance processes to say wrench time analysis. How can you reduce the time that an equipment spends in garage, for example? That's just paper-based, was very inefficient. When you digitize it, you realize that the actual rent time is much lower than the time that the equipment spends in maintenance window, right? Then we moved on to say, how can you better do your schedule unplanned maintenance or planned maintenance effectively, right? And that one came with condition-based monitoring. The early form of predictive maintenance is to say, let me look at some of the data coming in from oil sample analysis or my inspection analysis to say any indication to say, does this equipment need maintenance, right? And then we moved on to advanced condition-based monitoring to say that work with experts to create complex rules to say if chromium level goes down, if your iron content goes up, if this goes down, then it's a critical level alert that you need to intervene immediately, right? And this delivered like 70% of your value that you can get from maintenance in terms of reducing unplanned downtimes. Then comes predictive maintenance, which delivered another 10-15% over and above that. If you directly jump into predictive, you might say that predictive delivers a lot of value, but then you could actually do a lot more just by being descriptive and doing condition-based monitoring effectively well. And then predictive is more around looking at machine learning, failure rates, and then your operational practices, and say, if you are producing this much at this kind of a production schedule, what is the likelihood that something will fail? And then you try to prevent that from happening. It's an art and a science to get right. But if you do it well, you get like 10-15% over and above what you get from condition-based monitoring. The final one that we are seeing now is prescriptive maintenance. And prescriptive maintenance needs a lot more data because it builds on top of prediction. And then says, when the last time this happened, this was the kind of interventions you did, and thereby helping you avoid a costlier maintenance activity if a simpler alternative exists. And this one was very prevalent in oil and gas companies where the cost of maintenance is super significant, but it is seeing early adoption in mining equipment in terms of older fleet, for example, where the chance of failure is high, where we are, unfortunately, not many mining companies have that much rich maintenance history in terms of what solutions they applied the previous time something happened. Hence, it's a bit of a difficult one where you can actually look at, last time this dump truck or Caterpillar 785 had this kind of problem. These are the 5 different solutions applied, and the probability of this solution being effective is Y percentage. Then you reduce the time it takes to intervene, and it reduces the cost of maintenance and put the equipment back on operation effectively. It's one of the biggest levers that we have seen moving from digitalization all the way to prescriptive maintenance.
Yeah, thank you. Thank you, Mr. Gopalan. Those were the questions I had in mind. If somebody wants to ask anything, they can just raise their hand. I don't think any other questions are coming from the audience. So it's time to wrap it up because we're already running behind the clock. Thank you so much. Your insights were truly, truly precious. To felicitate Mr. Gopalan, I would like to call upon stage Mr. Simon Nicholas, Lead Finance and Analyst of IEEFA. Mr. Nicholas. A round of applause, please. Thank you, Mr. Nicholas. Thank you, Mr. Gopalan. Thank you very much. So this brings us to an end of 1.5-day conference, which saw brainstorming sessions and very positive interaction on an array of topics related to the coal and coke markets, global geopolitical trends, which way are the currents going, where are the countercurrents also, and how is it affecting global trade and prices, and of course, what is the outlook going forward for this industry. So we had a very, very creative and interactive 1.5 days of discussion, for which I would, on behalf of Team Coalmint, want to thank everybody present here. Thank you once again very much. Dinner is being served on the hall right adjacent. Sorry, I'm very sorry, excuse me. Lunch is being served in the hall adjacent, so please feel free and have a nice time. Thank you so much.